All right, this is going to be the most comprehensive training on trading that you've seen on YouTube. So it's going to be a long video. This is a recent workshop that we ran that went on for 3 hours, and we cover everything. And this workshop that we put on, we normally do these over 3 days, and we condensed it down into 3 hours. So there's tons and tons of value here. So first things first, this is going to be one of those videos that you're really going to want to watch a couple of times, or reference back to certain parts that you can't quite grasp first of all, so you need to go back to it. So make sure you save the video, and also introduce yourself in the comments. We're really trying to build out a trading community here, so it's not one of those kind of silly get rich quick things where people are away with the fairies. We're building a real professional community here, so let us know who you are in the comments, and I look forward to meeting you and greeting you down there. And lastly, make sure that you've got a nice space with no distractions. Okay, you might want to save this video and download the video so you can watch it when you don't have Wi-Fi, if you've got YouTube Premium. Because it's going to be, this isn't one of those videos you're going to want to quickly skip through. This is something you're going to want to watch and absorb the information and take on board what we're saying. So over the next 2 hours and 40 minutes, or nearly 3 hours, I'm going to be sharing with you so much information. Myself and my trading partner, Akil Stokes, we're going to walk you through everything you need to know in order to set you up for successful trading. So enjoy, get stuck in. And if you need to, all the timestamps are on the timeline there. So if you need to rewatch any of it, you've got that there as well. But yeah, let's get stuck in. What have we got? We got a mission, very, very simple mission here. And that is to empower aspiring traders, whether you're brand new or not, about the truth about trading. And we're going to be providing transparent, no nonsense education, practical strategies, real world mentorship and coaching. And our goal is to just cut through all of the noise, expose the myths, and equip all the attendees with the tools and the mindset and the discipline and the strategies and everything you need to succeed in the financial markets. Our only mission is to create profitable professional traders. All right. So if that sounds good, we've got a value stacked agenda. So I'm going to do a bit of an introduction and where the opportunities lie right now, why we're even running this workshop. Then we're going to go into price action and fundamentals. Then we're going to go over to Akil. He's going to talk about some price action technicals, get stuck into the charts and learn about price and stuff like that. Then we're going to look at a technical trading strategy. So I'm going to walk you through a trading strategy. Then we're going to talk about risk management. And then I'm going to talk about how you can develop some confidence and everything that you need to go forward into the live markets. So very, very directionally correct. This is the quickest way, no nonsense, to get from A to B. As I said, myself and Akil both have a strong passion to help traders. We've been doing this a long time now, and nothing makes us happier than to see traders get through breakthroughs, succeed, tell us the stories about either they got funded or they've doubled their account, or they're making consistent profits for the first time. They're doing $200 a week or $200 a month or whatever it might be. Any win, we really get off on that. So that's why we're here. And you're in a great community. Lots of the traders in our community are often telling us that how much they love the platform, love the community, love myself and Akil, and love each other. And it's just a big love place. I've got lots and lots of we tend to know our traders on a name by name basis. It's not just like you're a number. So that's why I want to get to know everyone in here as well, because we've made many friends over the years, like Shah, and we do meetups. You can see Tony there, Hyetul. We got all the guys that have come through. We know on a name by name basis. Thomas, Tim, Gabrielle, Mark. We got Paolo, Hassan. Florent, wow, Florent as well. Lovely, lovely community, and you're in the right place. So if you've got any doubts about being in the right place, this is one of the only trading communities that I've seen where we actually, communicate, integrate, meet, and mingle with our guys, because we want to be part of it. So really, really quickly, I'm not going to go too much about this, but if you've come in and you don't know me, maybe you've come in from Akil. I'm Jason Graystone. I'm an entrepreneur investor and we run tier one trading. I've spoken on many different stages all over the world, featured on all the podcasts, been on TEDx, been in Forbes, been in Global Man, front cover, Global Man magazine just last week, which was absolutely phenomenal. And those of you who found me through, don't know, I've got a YouTube channel, loads and loads of trading content over there. Or maybe you found me through the podcast, or if you don't know who I am, I do have a podcast all about wealth creation, which went to number one in on iTunes. But what you're really here for is because we run a comprehensive coaching and mentorship program that is unparalleled called Tier One Trading. And it was so innovative that we, as soon as it launched, within a few months, we got recognized by Dr. Brett Steenbarger, and he interviewed us for Forbes magazine for the innovation in trader training that we'd managed to develop and achieve with Tier One Trading. But before all this, I got into trading when I was a lot younger. I've lost my hair and then regrained it back. But I lost a lot of money learning to trade. I had a lot of lessons. And when I was about 22, I decided I was going to become financially free. I didn't know how. When I got to my mid to late 20s, I discovered trading, and then there was many nights of backtesting and losing trades and donations to the market. And then as soon as I was able to become profitable in trading, that was like the secret piece in the puzzle for me. And within a very short period of time, I'm then moving my family into our dream home, and at which point no one knew who I was, by the way. We just moved into this amazing house. And yeah, within a very short period, I was able to completely replace my income, live in a dream house, and have all the dream holidays and all the rest of it. And it's been an amazing ride. Since then, I've had some wildly profitable days, my most profitable being 6 trades on the 3rd of April 2020, netted $168,000 or £133,000, which ended very messily with some tequila. And I woke up on my floor and with people waking me up, and I can't remember much else, but funnily enough, I stopped drinking very soon after that. Very, very soon after that. So here's the facts, guys. Here's why we wanted to run this workshop. 2010s, the decade of low volatility and steady growth. So there is a volatility index, and in the 2010s, 2010 to 2019, it was historically low. Okay, so the volatility index is known as the fear gauge, and it averaged about 17.5 from 2010 to 2019, right? And by comparison, the same index averaged over 25 from 2020 to 2023, right? With spikes well above 60. And obviously during COVID and everything and the banking crisis, it was really spiking high to that 60 level. In 2017, the volatility index hit its lowest average ever recorded at 11.1, which was a sign of historically low market volatility, right? Now, on top of that, the S&P 500 growth was really, really steady and predictable, delivered a return of over 250% from 2010 to 2019. By the way, those of you who saw me, I basically just before lockdown, I wanted to prove a point that if you invest in the S&P 500, you'll get 10% per year. And I opened an account for my sons, and we tracked that thing until today. It's now at 56%, which is averaging 9 to 10% per year since 2019. And the S&P 500 has done that very, very well. So I'm not saying that that's a bad thing. What I'm saying is it was very, very, very predictable. There was no bear markets during that time until COVID. And then when we saw COVID, we saw that big V, that V-shape recovery. And only 2018, in that 2010 to 2019 period, had a negative return of minus 6.2. And all the rest of the years were positive. The rate environment was stable. So interest rates hovered at about zero for most of the decade after 2008. The Fed only began gently raising interest rates in 2015. And Now I want to talk to you about why the 2020s is a little bit different because we've got COVID shock. Okay. So the fastest bear market in history. We had that big V-shaped recovery. The volatility index hit 82.69. This will all make sense in a moment. Interest rate shocks, fastest rate hiking cycle, wars, geopolitical risks, AI driven volatility, retail influx, election years, right? So you've seen it in the news. You've seen, particularly in the UK, right? There's campaigns all over about raising the flags and what that's causing, problems with politics. And then there's the UK's radical immigration and deportation proposal. And there's all that stuff going on and immigration coming across the channel. Have you seen Elon Musk now tweeting about it, offering to fund all of the legal fees for any corrupt UK government? I mean, that's crazy. Someone with that money and that power and that influence getting involved is going to cause ripples through the UK. Okay. We've got rising anti-immigration protest on the 13th of September. Tommy Robinson is running a massive, huge demonstration in London for patriotism in the UK. And then you've got Trump's tariff wars, right? All this kind of stuff. People like campaigning for tax the rich campaigns. Gary Stevenson, really making a noise, really making a mess. Really, you should maybe spouting off too many things that he doesn't have a solution for, but it's causing ripples. It's causing more and more ripples. Who's seen Gary Stevenson? Just recently, even like in extended parts of the world, Indonesia, there's these protests going on, displaying pirate flags, symbol rebellion. They've got this rebellion going against economic restraint, rising property taxes, and all the rest of it, right? So lots and lots of unrest. And although you might see one story at a time, until you see it like that, and that's only a handful that I've just shown you, you can start to see where things start snowballing, right? Things start becoming very volatile and out of control because there's too many things going on, right? So if you're thinking about passive investments now or a nice steady climbing stock market, that might not be the case for the next 10 years. We're about to see something much more volatile. And unless you've got a way of taking control of that situation and not being affected by that outside noise, you're gonna be in panic mode a little bit, right? So the thing about trading is you don't need to care. And why don't you need to care is because you imagine all that is on the outside world. All that's going on the outside world. Well, in a trader's world, we're just looking at patterns. And patterns come from human participants, and human participants have the same human psychology that they've had for thousands of years. And we do the same things over and over again, and economics does the same things over and over again. And the direction of value and the magnetization of value and how that works and supply and demand always works the same way, and it has done since the beginning of time. So when you're a trader, it's kind of like you're in this little bubble where your friends or someone will say to you, oh, what do you think of this? I bet that's affecting you. And I bet that's, oh, what's Trump doing? I bet what's your trading like now? Trump's up to this. Gary Stevenson's saying this. Well, Tommy Robinson's doing this. How's that affecting your trading? And myself and Akil, we look at like, it's not, it's really not affecting anything. And yes, to a degree, there's periods of time where things might be a little less, there's a lot less going on, or there's a little bit, bit too much for my liking. But overall, none of this stuff affects our consistent approach to the markets. And that's what you want. It's such an empowering position to be in. Everyone understand? This is why, if anything, this is the reason, this is the only reason you want to learn to trade, because you've got this empowering way of controlling your income and having certainty in your income, regardless of whatever nutcase, crack job, or jumped up politician wants to do. You really are not giving your power away to any of those people. Make sense? There is a very small minority of people that actually become good at it. In fact, it's like 1% of all traders can profit net of fees. Okay. So why is that? Well, the reason it is because 95% of traders lose money because they're jumping ship to ship, system to system. They never get past demo accounts and they go on YouTube and they try and learn how to trade on YouTube and they find this guru and that guru and whatever guru. When what they end up doing is chasing magic indicators, strategy hopping, no clear plan, no feedback, and they're making emotional decisions all the time. And with all that news going on the outside, it's no wonder that that starts to creep into their decision making in their trading. They become very fearful and then they lose consistency and then they can't do it. But in reality, I want you to know this: trading is very, very simple. The concept is very simple. And when you look at it, how we're going to teach you over the next 3 hours, it's actually easy. It's actually easy. The difficult thing with trading is you having the discipline to put in the work and do what we're going to tell you to do. And that is it. If you do the work, you'll have results. It's the same with everything. I mean, I remember seeing Warren Buffett. He was interviewed, I think it was CNN, and they interviewed him and they said, why, your strategy seems very, very simple. And he said, well, it is. And she said, well, if it's so simple, why doesn't everyone do it? And he was like, you tell me. People don't want to get rich slow. And when he says slow, he means they don't really want to put in the work to get there. They just want to do the thing. Whereas if you just take a step back, you can make 10 steps forward much quicker than you can just jumping, strategy hopping, system hopping, and all the rest of it, right? Another little kind of myth I just want to take your eyes off for a second is the prop firm challenges, because yes, there are some benefits to some of these prop firm challenges, but a lot of people are putting all of their hope in the fact that they can just apply for one of these challenges and then miraculously, luckily get through it, and then that's it. Well, that's not it, because you've actually put yourself in deeper water because you don't know how to replicate the results you just got back by luck. And now what you've got to do is you've got to try and replicate that, and it's going to be, it's going to put even more stress on you. So there are these firms out there offering you the chance to fund your account if you pay to enter the game. And when you pay to enter the game, they then make it very difficult for you to succeed as a trader. And if by chance you get through by a quick stroke of luck, you've then got to replicate that luck on a month-by-month basis. And every time you don't, they've got a reason not to pay you. And that is how they work. That's how they work. Most of them work that way. There's probably 2 or 3 now that have to up their game, but the rest of them, let's not think about that just yet. What we want to focus on is getting good at trading. Because if you get good at trading, guess what? You don't give your power away to these. And if you do want to go and do one of these prop firm challenges, you're in control. You're in control. You've got confidence that oozes from you. The other thing I just want to abolish right now is that brokers are out to get you. Okay, brokers make money by commissions on your trading. They want you trading. Okay, they get paid from your trading volume, which means, yes, they get paid every time you get in and out of trades, but that's what they are. They, in return for that, they give you access to the market and you're able to trade because of them. And there's this whole saying about 90% of traders lose 90% of their capital within 90 days of opening their account. And that is pretty much true. That I haven't got any, I've got many studies around roughly the same figures. I don't think there is an actual accurate figure for this, but it's this 90-90-90 principle where 90% of traders open a trading account and then within 90 days they've lost 90% of their account and they close the thing down, right? And the reason for that is because people are system hopping. They don't have trust in their system. They don't know what they're doing. They're taking signals from other people. They're taking trades from that they've seen on Pip Daddy and all the rest of it, right? And they don't have any empowerment when it comes to trading whatsoever. And they're just hoping, being inconsistent and miraculously thinking that they're going to somehow double their account, triple their account. And they're chasing a get rich quick, basically. But there are brokers who have an A book and a B book where basically a broker will assume that you're going to be a terrible trader. And what they'll do is they will put you on an A book where if you think about, sorry, they'll put you on a B book, but on an A book, if you think about what happens in a broker is basically you place a trade, they put you through liquidity provider through to the interbank market, and then they fill your order, and then they give you your profits on your trade. Your order is really going through the interbank market. But if you're with some brokers, what they'll do is they'll put you on a B book where they don't bother filling your order. What they do is they just take the opposite side of your trade, knowing that 90% of traders fail over time. So they've just got to last 90 days and they're going to end up with your money. Okay. So in other words, they won't fill your order. They'll just they'll pay for your wins, knowing that you've got to pay them for your losses, and over time you'll lose. And then when you become good at trading, what they'll do is they'll shift you over to that A book. And this happens. And unfortunately, that is not illegal yet. Signal services. Signal services don't work because you are reliant on the signal. You've got no idea why they're giving you that signal. And therefore, if you take certain amount of losing trades in a row, you're not going to be able to stomach the next trade. And what you'll do is you'll reduce the position size, or you'll stay out of the trade, or you'll jeopardize the system somehow, or you'll get greedy on the next one to try and make it back, and you'll break the system. And all of that because you don't understand the system. Okay, let me give you an example. Bitcoin has only ever gone up. If you look at where it started in 2009 and where it is today, and look at the chart, it just does this, right? Yes, it's got little ups and downs in between, but it's gone up over time. And yet thousands of people every day lose money in Bitcoin. Why? Why? If I said buy Bitcoin and you buy it, how are you losing money? If someone says buy Bitcoin and you buy it, they've told you to buy it, how have you lost money? Well, it's not the signal, is it? Think about it. It's not the signal. It's you. It's your inability to maintain poised and confident in the signal. And why is that? Because you don't understand it. So that is why signal services are terrible. Okay? Pointless. Absolutely pointless. It's no different from going into a betting shop and seeing the old boy that's in there every Sunday, and you say, "Oi, Jim, what's a good tip? What's a good horse today?" And he goes, "Well, mate, you get on the old double silver or whatever, and you put it on double silver, and guess what? He's right some of the time, but you don't know what he knows. That's the end of it. You don't know what he knows." Then I just want to steer you away, because really the point of this introduction is just to kind of reset your approach to trading. I don't want you dicking around after you've been to this workshop, right? You'll see all this crap all over social media where they're showing you their screen and they've got about 100 million trades on the same pair. And if you know what you're looking for, you can tell in an instant that this is all BS, because you can tell the position size, the size of the risk they've got on, the amount of trades they've got on the same pair. And what normally happens is they have multiple accounts. And what they do is they take the inverse setups on both accounts. So they'll go long on one, short on the other, long on one, short on the other, short on one, long on the other. And then after a period of time, one will be winning and one will be losing. And what they'll do is they'll just delete the old account and show you the winning one, which is legitimately a winning account. But what they haven't shown you is the fact that they've break even overall. And you see these knobs doing this everywhere. It's everywhere. And it's just ridiculous. Right? No, they won't like me for this, because I've just basically exposed their number one little tactic. Great. So I want to talk about, we're going to get really practical. We're going to go over to Akil in just a moment, but there are lots of advantages of being able to trade Forex. Okay. The first one is it's a 24-hour market. So it's 5 days a week. It doesn't open and close each day like in the stock market. So there's no big gapping or massive fluctuations in price from day to day. You don't get any of that gapped movement, which I'll explain when we look at the charts. No one can control price. It's too big of a market. Nearly a $6 trillion market, which is incomprehensible in volume when you're trying to compare it to what even a billion is. You know, they say if you go back a million seconds, you go back 12 days. If you go back a billion seconds, you go back 12 years or 30 years. And if you go back a trillion seconds, you go back to the Ice Age. So just to kind of see the comparisons there, just to give you some context of how big the market is as opposed to what you think it is, it's huge. It's massive. Low costs, low cost to enter, right? So very, very low cost. You can start with very low capital as well. High leverage, which is a bonus and a double-edged sword. High liquidity, you know, it's very volatile as well. There's lots of opportunities to make money. And you can make money when the market's going down as well. So you can easily short the market just as much as you can buy the market. And this is a concept that a lot of people struggle with. One of the most common questions on my Trading for Dummies video, which is at about 8 million views now, is, "Oh, sir, I don't get it. How did you make money if the market was going down?" It's a very undereducated concept, but it's shorting. And it's basically you're the other side of the market. So if you're buying pound dollar, you're buying the pound dollar. But if you're selling the pound dollar, you're basically buying the dollar pound, right? So it's the other way around. So what you actually need, and this is what we're going to provide you today, is a proven strategy, something that's real, that's had back-tested data, that's got feedback from experts and structured path to follow so that you can just get from A to B as efficiently as possible. And in order to do that, there's really 4 key skills that you need to learn. They are understanding of basic like behavioral tendencies, which isn't that difficult when we start to show you the stories of price and pattern behavior. Understanding basic mathematical probabilities, which we're going to show you. Understanding basic pattern recognition, and then understanding how to transcend your own emotional reactions. In other words, having discipline. Discipline to be consistent at trading a system that is based around behavioral tendencies and patterns that happen frequently. And then you have the mathematical probabilities on your favor to have an edge in the market. That's all trading is. Those 4 little points there, that's the complex version of what trading is, believe it or not. So the technicals, which we're going to start teaching you about, what you really need to learn in trading to become a great trader, no matter what the system, what the strategy, what have you, is market condition, understanding how to read a market condition and understand if we're bullish or bearish or consolidating or indecisive, if we're trending, if we're reversing. You need to understand all that stuff. Then you have to understand market phases. So the run and the pullback, the extensions, the outside returns. Then you have to understand support and resistance. If you're going to be a really good technical trader, you're going to understand from what we're going to show you in a minute that support and resistance trumps all, in my opinion. Okay, so support and resistance is everything in trading. Then you're going to want to learn some indicators to add weight to your entries and build a CTS style of system where you can give a scoring system to your entries so that you can build up confluence. Then you're going to want to learn some price action patterns, the story of price and what price action does. And then finally, candlesticks, how to read candlesticks and the anatomy and the stories that they tell you as well. For this particular setup, this is a question we always get asked, so I'm going to share it with you now. I'm going to be using TradingView. I think Akil will probably be using TradingView. If you haven't got TradingView and you want to play along, scan the code. It will go and put a browser. Even if you do it later, you can then go and sign up for TradingView. This is the platform we're going to be sharing with you for the demonstrations of this. Akil might be using NinjaTrader, but I'm going to be using TradingView. And we're also going to be then talking about brokers, which I'll share with you in just a moment. But right now, we're going to go over to Akil and we're going to start talking about price.
We'll go to the deal here, but yeah, in the middle of managing a trade right now, in the middle of some high impact news, so volatile news, as you guys can see, and we'll kind of check on this a little bit later. But yeah, let's head over to the presentation. We're going to talk a little bit about price action today. Going to talk about some of the patterns and formations that I want you to see. Real quick, just a very brief background of, I guess, me. I started my trading journey, I guess you can say, in 2007. I graduated college. I went right into investing into the stock market, ended up falling in love with it. In 2009, I made the switch from the stock market, right, to specifically Forex. And a little embarrassing to say this, but the main reason was because I was told by a friend of mine that, hey, the Forex market. I'm like, what is this Forex market? Like, I've never heard of it. You can, buy and sell currencies. I'm like, okay, I didn't even know that other international currencies existed, right? But I was told the things that kind of perked my ear up, where it's like, hey, you can make more money starting with less money because it's leveraged and do so in a quicker period of time. So it was like the trifecta. I can make more with less in a shorter period of time, and I was all in. I knew nothing about technical analysis or anything like that, but I jumped in and bet on myself. Long story short, I didn't become successful as quickly as I thought. I went through pretty much everything you can imagine as a trader, similar to Jason. That's one of the reasons that we've become such good coaches, because we've literally went through all of the struggles and the problems that you guys will ever face. Unfortunately, I came out on the better side of things. Went into money management after that. So I managed trading accounts for people. Discovered really, really quickly within about a year that I hated it. The most stressful thing I ever did in my life, hence my hair being gone as well. And then after that, really accidentally stumbled into coaching. I always had a passion for helping people, and was kind of asked to start coaching in 2012. I kind of said no for about a year while I was doing the money management thing. But once I did it, just fell in love with it. One, it keeps me sharp as a trader. But again, it's really cool seeing the stories and the success stories of people kind of making it and being able to literally change their lives and achieve their dreams, and knowing that, we didn't make it happen, but we played a small little part. Um, Now, real quick, just kind of trading specifically. In my trading journey, I went through the similar process that everyone goes through. I first started off just looking for a system where it's like, okay, let me kind of look around the internet, browse the internet all day. I quit 3 jobs to pursue trading, which wasn't smart, but I had all day to browse the internet, and I just system hopped. I went from system to system to system, and then it would win for a little bit, and then it would lose, and I'd blame the system, and I'd find the next one. It would win for a little bit, then it would lose, and I'd blame the system, and I would find the next one. I did this repeatedly over and over again until I ran out of things to blame and realized it was me. Long story short, I ended up settling on the thing that I was told to pursue first, which was a basic study of price action, learning how to read the market, understand support and resistance, supply and demand, pattern recognition. But of course, you don't want to hear that when you're younger. You guys want to hear the magic thing that's going to make me money. But I came full circle back around to that, and now that's been kind of the spinal cord and the backbone of my trading. Now, what you're going to learn in the next 45 minutes, hopefully, I will try my best to keep this to 45 minutes, but the basics of reading Japanese candlesticks, understanding basic principles of momentum. The theme of this has been kind of volatility, momentum. We're going to talk about candlestick combination patterns, the basics of reading trends, support resistance, how to make accurate predictions in the market using price action, some key price action patterns, and then a little bit about placing dynamic and fluid stop losses. So I apologize in advance if I go through this pretty quickly, but each of these is a segment that we can probably spend an hour on in its own right. And we just want to give you kind of a general idea of everything that you need to know. So let's get in. Let's start by talking about the basics of candlesticks. If you're a veteran trader, you know this already. So it'll be a refresher. If you're new, this is simple, but also very, very important and often overlooked. But this is what a Japanese candlestick looks like. On your left is going to be a bearish example. On your right is going to be a bullish example. There are two main parts of the Japanese candlestick. There is the body and the wick. The body is going to be the thicker part, the shaded in part. So if you look right here, this shaded in part is going to be the body of the red. The shaded in part is going to be the body of the green. The skinny part, the legs, the tails, the wicks, those are going to be the wicks. And each tell us a specific and very important story about the market. So the body tells us the range between the open and the close. So each candlestick is printed based off of a session. So a session is based off of the duration of the chart you're looking at. So if you're looking at a daily chart, for example, every candlestick is going to represent all of the movement that happened with price during that day. The open, and we'll take the bearish example right here, which is going to be the top. This is where price opened once the day began. The close, which is going to be here at the bottom, this is where price closed once the day ended. So the opening and the closing price. Now the wick, the skinny part, that's going to represent the high and the low. So the highest point of the wick right here, that's the highest that price action moved, the most expensive that price got to during the session. And the low is the cheapest that price got to during the session. And this represents the entire range of the candle. So again, simple and straightforward, but this is going to be very important as you go through your trading and reading the story that the market has to give us. And again, in my opinion, and I did this myself, this is one of the most overlooked things in trading. So many traders spend so much time chasing a system, chasing a strategy, where the best clues and the clues that have existed in the market for all of time, right? Since the beginning of time, or at least since even before candlesticks were a thing, they're right here. This will tell you all of the actions that the market participants are doing, and it gives you clues about strength, weaknesses, stuff like that. So do take this seriously. Next, we're going to talk about reading a candlestick strength. And this is where taking that open, high, low, close to a different level. So we're going to classify these, we're going to simplify things because Jason and myself have simple brains. We like to kind of make things as simple as possible for the dumb traders out there. We want to classify these candlesticks into three main zones. We want to have strong candlesticks, we want to have neutral candlesticks, and then we want to have weak candlesticks. So these are all going to be bullish examples. So remember, in a bullish example, the open is going to be at the bottom, the close is going to be at the top. So a strong candlestick is a candlestick that closes in the upper third of the entire candlestick's range. I'm going to repeat that, right? A strong bullish candlestick is one that closes in the upper third of the entire candlestick range. This means that the bulls had a strong session. You can say that they won the session, right? Imagine like a tug of war or any type of sporting event. They won that individual session. They outpaced or defeated the bears, you can say. A neutral candlestick is going to be one where the price action closes, right? The candlestick closes in the middle third, right? Now, real quick, does anyone know what this candlestick is called? These candlesticks have names, right? Some of them have names. You don't need to know the names per se, but yeah, this is going to be called a doji candle. It is a sign of indecision. So again, if you imagine this being a tug of war, the opening of price came right here at the bottom of the green. At some point, the bears pushed it all the way down. They had momentum. At some point, the bulls pushed it all the way up. They had momentum. And then we end it kind of right in the middle, stalemate, a draw, a tie, neutral, right? So it doesn't really give us a bullish bias, doesn't really give us a bearish bias, but we call it indecision. The market's having a think. It's a little bit of a pause, which can be a very powerful signal in its own right, especially depending on what that candle comes afterwards. Next is going to be a weak candle. So again, if we want to write the story of this candle, price opened right here, always opening at the bottom. At one point in that session, the bulls were able to push price all the way up. How do we know that? The wick of the candle is all the way up here. So it was a very strong start to the session. However, that momentum was lost as the bears pushed it all the way down, and we got a close in that bottom third. We call this a weak candle. And here's the thing. Although this is still a bullish candle, it is green. The close is higher than the open, which technically makes it a bullish candle. Do you think we would look at this as a strong bullish sign? If you were to see this on a price chart and this came after a certain move, would you look at this and be like, oh man, bulls are in charge? Or would you kind of be like, I don't know, this is more of a bearish looking type of move? You'd probably see this as more of a bearish looking type of move. And again, this is key. We typically look at candles as everything green is bullish, everything red is bearish. But that's not always the case, right? You can have a technical bullish candle, which gives you a bearish signal. You can have a technical bearish candle that gives you a bullish signal. That's why it's so important that you understand how to read the story that these candlesticks are telling you versus just being able to kind of shortcut it and be, green bull, red bear, or something like that. So we're not going to go through the bearish example, but it would be the exact opposite because the opening's at the top, closes at the bottom. But I'm going to try to save time here. So the next thing we want to look at is reading candlestick momentum. So this is kind of taking it to the next level. We measured strength first, right? Strength is going to be where it closes within the full duration of the range of the candle. Next, we're going to look at candlestick momentum. How do we measure candlestick momentum? And I have a very simple formula for you. Ready for it? Small candles, tiny, equal lower momentum. Large candles, big, equal higher momentum. I'm going to say that again. This is complicated stuff, right? Small candles equal lower momentum. Large candles equal higher momentum. Now, one of the common questions that I get is, well, how do I measure a large candle versus a small candle, right? So there's no actual mathematical measurement for that. There's no cheat sheet that says, hey, if it moves 100 pips or 100 ticks, it's a long candle, but if it moves 99 and below, it's a small one. It's all relative to previous candles, right? So large is relative to the candles that happened before it, small relative to the candles that happened before it. It's all about reading the mood of the market because as Jason mentioned earlier, we're going to have times where it's high volatility and you're going to see a lot of large candles. There's going to be times where it's, summer is a great example if you ever traded during the summer, where there's sometimes lower volatility and the market's just not moving outside of a massive range. So it's all about measuring them in comparison to what has happened in the past. So here's a good example right here. You can see price action has moved up on a chart. You can see that we've had some large candles. What would you call these candles? Would these be high momentum or low momentum? What would you guys say? Type it in. Type it in. Just realized I can't even see you guys. Where's my chat at? There we go. Bring that up for you guys. No, there we go. Get it out of there. Yep, high momentum. Now, if you look at the next couple candles after that, what would you classify these as? And I apologize if I missed any questions. My chat was hidden behind my screen. Would these be high momentum or lower momentum, right? Low momentum. Now, I love what I'm seeing in there too, because not only did some of you guys say low momentum, but you added low momentum and indecision. Well, how do we know that they're indecision? You guys are sharp. It was funny. Someone asked me the other day about these workshops, and they were like, why do you guys charge to do it? And I said, well, something that we've noticed is that when we charge even a small fee, we collect a much more serious group of traders, right? A lot of times when you do workshops, people show up just to be a nuisance, right? They show up and they just want to tear the thing apart. Like they just love disaster. They come in, they start like spamming brokers or making fun of people. Like I'm serious, like people wake up and do this. Like they wake up and say, this is what I'm going to do today. But if you charge this even like a penny, they won't show up. So we've noticed that when we've done this, we got really serious traders, right? We've got high quality traders, and it's no doubt we're seeing the answers like this because man, you guys are you guys are answering the questions before I even asked them. So I love that you said that, right? Not only are we seeing smaller candles, right, in comparison to the bigger ones, which means that hey, momentum is slowing down, but you're also seeing the doji candles, right? You're seeing the indecision candles, meaning the market has had a big bullish run. I mean, look at this. 1, 2, 3, 4, 5, 6 candles in a row. The bulls are winning. They're winning strong, big, high momentum bullish candles. And then we get a smaller one, and the market's like, hmm. And then we do it again, hmm. And then we have this one right here, doji, maybe a weak, maybe a strong bearish. I don't have to measure this out, but And then what do you see, right? A little rotation. We'll talk about slope in a little bit. I think I'm going to save that for a little bit later, but these are the small clues that you guys are looking for. And you just nailed it already. But this is also the stuff that no one talks about. And I used to like wonder, Jason and I, we used to speak a lot and wonder why no one talks about it. And then we realized because it doesn't sell. Like it doesn't, it's not the sexy stuff and people just want the boom, bang, sexy stuff. But this is the important stuff in the market. And if you can read price action, it just increases your edge, increases your edge. So next, let's talk about trends. I'm actually going to go to the chart well, we'll go to the chart a little bit later and draw this out. So that was kind of individual candlesticks, maybe a little bit of candlestick combinations, but understanding individual candlesticks. Let's talk very briefly about understanding trends. So long story short, the market can only move in three ways. It can go up, it can go down, it can go sideways, and it can do all of that going from left to right. If you ever want a really easy and simple way to identify the trend, right? I do this with my kids because kids have they're pure, I guess, and they don't overcomplicate things. If price action is going from the bottom left side of your screen, bottom left corner of your screen, to the top right corner of your screen, it is a bullish trend. If we're going from the top left corner of your screen to the bottom right corner of your screen, it is a bearish trend. Like so, if you remember nothing else, just zoom out your chart as far as possible and look for that, right? If it is going across the middle, then it's in consolidation. Now, if you want to break down a trend a little bit more and be more specific, in a bullish trend to start off with, what we're looking for is a series of higher highs and higher lows. So if you look at the little graphic in front of you, price has moved up. We've created an initial high. We then have what's called a pullback, a retracement, outside return. There's plenty of names for this. Whatever you want to call it is fine. But the fact is that it pulls back and it doesn't pass the previous low. Then we move higher and we create a higher high, right? So we have a series of higher highs. We pull back again and then eventually reverse a little bit higher than the previous low. And that's the series of higher lows. As long as we have this pattern going on, we're going to be in a bullish trend. The exact opposite for a bearish trend. Again, I don't think we need to spend too much time going through it. But again, we're looking for a series instead of higher highs and higher lows. We're looking for a series of lower lows and a series of higher or lower highs. Sorry, I was reading the chat at the same time. Caroline, I love how visual this is. Thank you. Yeah. Now, and I'm assuming is that crystal clear, guys? Just again, I'm usually spend more time on this, but I wanted to kind of not rush through it, but get through it quicker. Assuming you guys are educated. If you're not, that's fine. Type it in. And I can talk forever. Although we're going to try to stay within 3 hours, so maybe not forever, but crystal clear. All right. So let's dig into the next level of it. That's what we're doing. We always start with the basics and then we peel back those layers of the onions. Let's talk about 3 ways to measure the momentum of a trend. And the 3 things I want you to pay attention to today are this. 1, the length of the extensions. 2, the depth of the retracements. And then 3, there you go, fingers up, the slope of the extensions. I'm gonna head over to a chart and draw these on because I like working on charts more so. Oh, what are we doing here real quick? Sorry about that. Again, tracking this bad boy. All right. This was a trade I took this morning. Real quick, 5-minute chart. I can review it for you later. It's going to take into some of the concepts that we looked at, but I need to manage this and talk at the same time. Well, I'll do it. We'll leave it on and do it till when Jason's here. But let's talk about trends real quick. So I told you guys that a bullish trend is going to look something like this. We're going to have a series of, sorry about that. We're going to have a series of extensions, retracements, and extensions, right? So One key to measure the momentum of a trend is asking yourself this question. Are my extensions getting longer? Now, pop quiz, because I like for you guys to be interactive. If my extensions are getting longer, remember these moves right here are going to be the extensions. Do you think that's a sign of higher momentum or lower momentum? What do you guys think? Higher momentum, right? The bulls in this bullish trend, yep, well done. They're able to make stronger pushes up. So if we see a series of movements that look like this, and I'm really tempted to get into like Dow theory and Wyckoff cycles, but I promised I wouldn't. I promised I wouldn't this time. But if you see a series of moves like this is a strengthening trend. It is gaining momentum. Vice versa, if we see a trend that looks something like this, what does this tell you? Again, we're keeping an eye on the extensions for round one here. So the ones that go up. Yeah, it's slowing down, right? Price started off with a bang. It's like imagine I used to run track, I coach track, right? I don't know how many of you guys are familiar with track. There's a race called the 400-meter dash. Anyone familiar with the 400-meter dash? It's one full lap around the track. Hurts like hell. Oh man, you go through every single emotion in that race. But I often used to kind of, and I encourage my athletes now to do this. I often used to tell them to take it out hot, right? And what happens is you go out fast, right? The person that never ran it before, you go out fast, you run, you run, you run, you run, you're feeling good, and then you get around the first 100, and then you start to slow down because you're tired, and then you kind of slow down for the second 100, and then you get more tired, and then you slow down for the third 100. And then that last 100 is like a walk as you're looking at the fans pleading for help is the worst. But that is losing momentum. You were literally slowing down and your body is saying, I cannot do this anymore. Someone help me. Best race to watch, better than the 100. Yeah, I was a 1-2 guy. I was a 400 guy too. I didn't want to admit it. But yeah, it's a great race. It doesn't feel good at all. But anyway, so this is slowing, there we go, words of momentum. So that's step one, the length of the extension. Again, I want you to take this information. We're going to put it into the corner, right, of somewhere in your brain space because we're going to revisit and put it all together a little bit later. So the next one, if you guys remember, was the depth of the retracement. So we know that these are our extensions. These are our retracements. Now, let me ask you this question. Which do you think is a sign of a stronger trend? A shallow retracement, or sorry, a deep retracement or a shallow retracement? Which is the sign of a stronger trend? A shallow retracement, right? If we're reading the story, a retracement is a little bit of relief, right? If the bulls are in charge, a retracement is a point in time where the bulls take a little bit of a break. Maybe the bears regain some control before the bulls eventually push it back up, right? So a shallow retracement shows us that, hey, the bears couldn't really push this down too far versus this one where the bears were really good at pushing it down. So take notes, the shallower the retracement, the stronger the trend. Now, again, when you're looking at shallow and lengths, again, it's all in comparison to the previous move. So if we look at a move like this, would you say that the trend is getting stronger or weaker? Again, we're keeping an eye on these retracements right here. Stronger or weaker? Stronger, right? Because these retracements, we had a long one here, a shorter one here, a shorter one here. Now, real quick, just kind of as a cheat sheet, and I apologize, we're not going to dig into this. I don't know how many guys are familiar with Fibonacci's. Are you guys familiar with Fibonacci's at all? If you ever want to go down a really weird rabbit hole, research Fibonacci's and you'll learn some weird stuff about seashells and petals and rabbits and length of middle finger to wrist and wrist to elbow. It takes you down this really weird path. It's crazy. It's quite literally a rabbit hole. You're right. My wife caught me once. I had my history was on. It was like rabbit reproduction, and she's like, "What type of weird stuff are you into, man?" I was like, "No, no, no, it's Fibonacci, man." I started off looking at a ratio, and then it took me to this. And I'm like, she's like, "Okay." It was also weird because it was around Easter, and I had a don't ask these questions, but I had a rabbit head, a mascot thing too, so that didn't help. It was a weird weekend for me. It's a true story too. I had like a rabbit mascot head. I was the Easter rabbit at my church for the whatever. Anyway, I slept on the couch that night because I don't think she was very happy with that. But anyway, so what we can do is we're gonna take a tool called our. We need a. There's a pic, Jason. I'll find one. If you look on Instagram, there's a pic somewhere of me in a rabbit mask, fully clothed underneath though. But I have a big rabbit head on. You gotta find it unless I scrubbed it. But anyway, Fibonacci, right? So I'm gonna take a tool here called my Fibonacci retracement tool. And what this does is it measures out Fibonacci levels. And again, think about Fibonacci levels for you guys that are unfamiliar as just being like retracement levels. So ratios that price action moves back. So it would be very similar, like if I said price action correct it by a quarter or correct it by a third or a half. Very similar, but these numbers are specific for reasons, right? I'm going to take my Fibonacci retracement tool, which I find right up here. I have the cheat sheet on. You can left hand corner here on your trading view deal. I'm going to measure it from the low of my extension, and I'll do this on a chart as well, to the high of my extension. And what you're going to see is it's going to give me some ratios, right? I have a 382, a 50%, which isn't technically a fib number, but it's a very psychological number. Human beings like halves. I have a 618 and a 786. So what you can do is you can tell the strength of a trend, right, by where that retracement comes back to. And kind of rule of thumb, if price action comes to the 382 before moving up, it is a strong trend. If price action comes to the 618, this is kind of considered like a normal retracement. It's considered, hey, a healthy retracement within a trend. Anything past that 618, this is going to be signs of a weakening trend. So if you're someone that is measuring moves that happen in the market and you're confused, you're like, well, how do I know if the move is getting shallower or steeper or whatever like that? What you can do is you can just take out your Fibonacci and be like, hey, well, that first retracement came to a 618. All right. That second retracement only came to a 382. So that means this is what? Weakening or strengthening trend? Pop quiz. First one came to 618, second one came to 382. Strengthening trend. Yes, that's a tool that you can use to measure it. And again, just looking at this in regular price action for just take any type of extension here, take this one right here. You can see that I would take my Fibonacci retracement tool from my swing low to my swing high. I'm looking at this move right here. And you can see that this didn't even make it to the 382, which is one of my reasons for taking the trend or taking the trade. So looking at a strong move here. So the last thing I want to talk about when it comes to the three ways that we can measure momentum of a trend is going to be the slope. So when I say slope, what I mean is I mean the grade of the move. So if I'm a cyclist, if you have ever cycled and you've climbed a hill, you know that the steeper the grade, the harder the hill, right? So the steeper the move up, the stronger the momentum of the move. The more shallower the move up, the less momentum that's in the move. So this is going to take time into account. Both of these moves move the same amount of room, right? This move from swing low to swing high moved 32 pips. This second move from swing low to swing high moved 32 pips. Well, then how can I say that this move was a higher momentum move than this move? Well, because this one did so in a much shorter period of time. Again, going back to the sprinting example, right? Imagine a sprinter running a 400 meter, running a full oval around the track in 60 seconds versus a distance runner that did it in 60 minutes. Yes, they both ran the same distance, but obviously one did it a lot quicker than the other one, which means one was moving at a much higher momentum than the other one. Got a question real quick. Said, what was the fib value of a weakening trend? Anything below the 618. The 618 is considered the natural pullback. So anything deeper than a 618 would be considered like a weakening trend. But in general, again, it's not necessarily the fib level. It's a comparison to the previous retracements. All right. So do you guys want an example of how to put this all together? I got a really good example to talk about momentum here. All right. Is anyone familiar with the head and shoulders pattern? All right. So the head and shoulders pattern is a classic price action pattern, and it's considered a kind of a complex loss of momentum pattern and a reversal pattern. So I'll draw it out first, and I'll walk you through what it actually looks like, right? Or how we read it. So a head and shoulders pattern looks like this. Let me know if you've ever seen something like this before. And then price action does that. Does that look familiar at all? This is supposed the top part's supposed to be the head, these two things are shoulder, right? So we've all seen this before, right? We've all looked at it, maybe we know what it is. But how many of you guys know the story of what it actually means? So let's start bar by bar, right? This is a long extension, right? So long extension, what does that tell us? Weakening trend, strengthening trend, what would you guys say? We're gonna write down our clues over here. I don't know how to spell, so I'm just gonna write strong, right? We have our first sign of strength. We follow it up with a shallow retracement, right? We can take our Fibonacci out if we want. Swing low to swing high. Oh, no, wrong tool. There we go. Swing low to swing high. Right here. So you can see it doesn't even come to the 3D2. Shallow retracement. Is this a sign of strong trend or weak trend? S or W? Another sign for strong trend, right? So let's add another one to it. Okay. And this is what we expect in a directional move. Now, who can tell me what happens here? I don't want to give it away for you guys. I want you guys to work. You paid all this money to work, right? What do you notice here? What do you see? What do you observe? I don't want strong or weak yet. What do you observe based on what I just taught you? What do you notice? Specifically, if we're looking at these two, a shorter extension. Now, what did I tell you a shorter extension was a sign of? Is that a strong sign or a weak sign? That's a weak sign. We're still in a bullish trend, right? No doubt. We're still in a bullish trend, but this is our first warning sign of like, hey, that extension is quite a bit shorter than the previous extension. Or insert the emoji, right? Now, next, we have this retracement. What do you notice about this retracement? And I saw a thing come in with the chat. I think someone mentioned earlier, reversal is coming. Now, remember, very important. We never know if anything is coming. All we're doing as traders is we're working in probabilities. So we never know something. The market can do whatever the hell it wants whenever it wants to do it. What we're doing is we're looking for patterns that put the probabilities in our favor. And then we're looking to consistently exploit those. And we never know if we're going to win trade by trade, day by day, week by week, month by month, but we know bigger picture. We're going to be on the right side more than the wrong side, right? So this is a deeper retracement, right? Again, if I bring my Fibonacci retracement tool in, we go past the 3D2, which was deeper than the first one. We go past the 618, and again, everything past the 618 is uh-oh area, right? So a deeper retracement. So that is another sign of what? Strength or weakening? Weakening. There we go. Words. Weakening. Oh, okay. Well, the tide has turned, right? We started off with strong, strong, and now we're weak, weak. We then have this one right here, which if this were a continuing trend, we would expect this to continue up. We have a failed extension that doesn't even reach the previous highs, which is going to be another sign of weakening. And then specifically in the head and shoulders pattern, what gives us confirmation, and we haven't talked about structure yet, but we'll dig into that next, is going to be a violation of our previous structure low. But do you guys see how we just read this pattern? We didn't just look at it. We didn't just say, ooh, head and shoulders, right? We actually read the clues. This is what we want you to achieve as traders. We want you to be able to read the clues, because the more you understand this, and the market is tough to trade, but the market does give specific clues, and it gives these same clues over and over again. The hard part is like they're jumbled in between a whole bunch of mess, like all the stuff that tries to sucker you and bait you into like trading every single day and blah blah blah. Like it's hidden between all of that, but it gives clues. And for those who can understand these clues, not only does it keep you out of the junk, but it allows you to see the things that maybe someone else doesn't see. And that's what separates you from those 90% of traders that fail. So real quick, we had a head and shoulders on, I'm just going to show you an example, and we got to move on. Was it pound dollar? We were tracking one in the live room all week. Pound dollar, yeah. So here's an example of head and shoulders right here. Not your greatest one in the world, but you can see kind of the general formation. I'll measure it out, where we have our move down. This is going to be our left shoulder. We have our head down here. We have our deep retracement. We have our right shoulder. And again, what we would look for is confirmation of the violation of this neckline. And that would give us the clue that, yes, the head and shoulders has completed. Now I can look for a move in the opposite direction. So now, real quick, just going back to structure, or going back to reading a trend, let's talk a little bit about structure, because this is going to be the most important thing. So we spoke about reading a trend here, right? Showed you guys a bullish trend, a bearish trend, right? Each time the market pivots, right? So it hits a level and then reverses off of it. This is going to become a level of structure. Now, it doesn't matter what you call this. Traditionally, structure up top is going to be called structure resistance. Structure at the bottom is going to be called structure support, right? But you can just call it structure. It honestly doesn't matter what you call anything. You can make up your own name for it. But what's more important is you understand where it is. Now, structure is important because it pretty much acts as a roadmap. This is probably the biggest revelation I made in trading is this. Again, I told you I went through trading all sorts of magic systems and fancy things, and I had a phase where I had 13 indicators on a chart. It was a weird phase. We all do dumb things, but and I felt bad. But when I finally came full circle and landed on structure, I realized that, man, I wasted my time with all this other stuff. Like indicators are good for for very specific reasons, but as far as like making predictions in the market, there's literally a roadmap that tells me where price is going to go, and that is structure. And even when we talk about high volatility news events, right? I don't know if have you guys ever been in a market and you've seen like a big we saw this last recently, right, with a big news event candle. Have you guys ever seen like really big candles in the market? Like really big, super stupid, dumb, like crazy candles, right? Here's an example right here. This one. You ever notice where they stop? Like if I just drew a line or a box out from the high of this candle, you ever notice where they stop at? And I'm not just handpicking this, right? You can when this presentation is done, go back through a chart, take a look at a level, any level you want, and just draw a line, and you're going to see, oh, meant to be a box there, sorry. You're going to see that price tends to stop at structure. Support, resistance, supply, demand. It is literally a roadmap, right? High impact news events, and I'll take you through a few of them later, they can move the market very quickly. They can determine the speed, the momentum of what price does directionally and how fast it does it. But if you can understand support and resistance, if you can understand structure, you're going to have you're going to be able to make very accurate predictions on where price is going to go. Now, understand that's different than trading, right? I'm not saying just because you can identify structure, you trade it every time. No, you still have to wait for the rules of your strategy to be met. But it's a massive edge, right? It's a massive edge if you know where price action is likely to go to as far as like target placement and where you should get out and make your money, where price action shouldn't go to for stop loss placement, where to put protective stops. I'm sure some of you have had some dumb stops. I'm sure some of you have put some stop losses on where the market just gets you and then it reverses. You're like, why did it reverse there? Must be my broker out to get me. Your broker doesn't care about you. Jason mentioned it earlier. The secret of your broker is this, right? Your broker doesn't want you to go broke. Do you know why? Because you make your broker money. Every time you place a trade, your broker gets paid. So why would your broker want you to go broke? They don't know. They want you to stay in the game as long as possible, right? But it's because we're just improper stop placement. And I'll talk a little bit about that at the end here. But if you can understand structure, it gives you a massive edge. So we look at the lines that I drew out, which I can't find, so I'll just delete them and draw some more out, right? And we look at levels of structure.
I just want to chop in here and say, if you're watching this far, congratulations. Most people fall off way before now. So I just want to say a massive hats off to you. Keep going. Keep going. We've got a little bit left to get through, but I'm glad to hear you're enjoying it. If you've got any questions at this point, you can always reach out to me on social or emails. All the links are in the description. But yeah, let us know in the comments if you have any questions.
And I want you to think about structure as being like this, right? Think about structure as being a magnet, right? So this was a previous structure high. After that previous structure high was broken, as price puts in a retracement, where do you think I expect that retracement to come to? Type it in. It always looks like the market hunts your stop loss. Yeah, it does. Yeah. Yeah, this will be the first level, right? It broke this level, it was pushed away. It's gravitated back to this level. This was a level that was important in the past. It's a level that's going to be important in the future. Now, if we turn around at this level and start going up, where do you guys expect price to go up to? Yeah, our previous high right here, because this is the next level of structure. And then if it breaks this level, we would look whatever's in the past beyond as that next level, right? It's a literal roadmap. And think about how valuable that's going to be for both your stop placement and your target placement. One of the biggest things I see in traders as far as mistakes go, and we work with a lot of traders, is that they're not necessarily bad at making predictions. As far as like, I think the market is going to, go bullish here or go bearish there. What they tend to be bad at or struggle with is when to get out of a trade. So we'll see a trader that enters a position right here, and they may put a target profit right up here. And let me know if you guys have ever done this before. And price action goes here, and then like it reverses and goes there. And this is one of the most frustrating things in the world because this trader was right in their prediction, right? The market reversed where they thought it was going to reverse at. It pushed up where they thought it was going to push up at. It just never went to their target level. And it's just a quick change can make a massive difference, right? Because this is a losing trade. You just lost money. versus a little bit of a smarter target placement, you just made money. So not only did you remove the loss, but you gained a win. It's a win-win for your equity curve. But it's very common just because a lot of traders don't think about that type of stuff. What do you hear on the internet? What do they only teach? Does anyone teach about target taking or stop placement, or is it all about the entry? It's typically all about the entry, right? That's all people. What's my entry? What's my entry? Right? Or yeah, always do a 2 to 1, always do a 3 to 1, which that's not really smart either. My technique for for entries and stops is or targets and stops are pretty simple. Want to hear it? Who wants to hear it? I know you do, but I want to hear you say it. I want to hear you say it. Yeah. Yeah. Tell me you want it. Tell me you want it. It's very simple. So write this down if you must. I place targets at the price point. Here we go. In which I think price is likely to go. I place stops at the price point where the market tells me that my prediction is wrong. It's as simple as that. Yeah. Yeah. Secrets. $7 secrets. $7 secrets. All right. I don't know how much how I'm doing on time here. I started my recording earlier, so it's all messed up here. But um, I do want to give you. You're good, man? Okay. I do want to give you a few good examples. So let's just talk a little bit about structure. Well, let's do this. I want to do a few good examples of let's talk about three key price action patterns that I want you to know. This is going to kind of take in. I gave you one, the Head and Shoulders. Um, oh, I saw a frowny face. Maybe I missed something. Oh, stop loss. Okay, yeah. So okay, I'll walk you through stop loss real quick. I'll give you guys two examples. Let's go back to the euro dollar example right here. Let's go down to the 5 minute chart, right? So here's a trade I'm in right now. It was doing good, and now it got sucked back into negative, right now. Um, and actually, this is going to be two good examples at once. 'Cause I want to talk about a reversal pattern called a 3 bar reversal. So let's talk about that first, and then we'll go to the stop loss. Stefan says, why the 5 minute chart? Because that's what time frame the trade setup was on. Yeah. So real quick, we get this question a lot. There's no magic time frame, guys. Whether you're looking at a 5, a 10, a 15, a 20, 35, 45, 1 day, 1 week, price action moves exactly the same on every single chart. There's a little bit more noise on the lower time frames and the higher time frames, but in general, it moves exactly the same. So there's no like magic chart. There's no super secret to why you choose a chart. As you get into like testing your strategy, you may see that, hey, certain time frames maybe perform better than other ones based on whatever the specifics of your strategy is. But yeah, there's no magic thing. I wanted to find a trade for you guys this morning, and I was talking to Jason. Markets were flat, as they have been this week, but there was a situation on the 5 minute. So I want to talk about a reversal pattern called a 3 bar reversal. This is my favorite entry, right? And what a 3 bar reversal is this, right? So price is go to gold. I think gold is going to be flat. Oh, gold's well, a 5 minute chart. Yeah, gold's flat too. Look at this. Yeah, there's nothing happening here. Yeah, look at that. This we call these train tracks, right? The market's not really doing anything. It's going up all the way down, back up. Yeah, so it's this is a good example, right? The market is moving, right, guys? But is it moving in any type of relevant way? And this is one of the things that gets traders into trouble is we see movement and then we get all excited over the movement, but it's not relevant movement necessarily. And again, it's going to be different depending on your strategy. Everyone is different, but you know, one of the things that happens is, and I'll talk about this a little bit later, is like we get FOMO. we see gold doing what it's doing. It's like, oh crap, I gotta get in, I gotta get in, I gotta get in. And then you're on the internet and everyone's like, hey guys, just took a long on gold, made this many dollars, and then like, oh my gosh, everyone's making money but me. Boom, and you buy it. And then it goes like the opposite direction, and you go home later like, this wasn't part of my plan, and like you trade it just because you felt like you needed to get involved. That is one of the main reasons that traders self-sabotage, fear of missing out, FOMO. Oh my gosh, it's moving. I'm going to miss it. Let me do something I'm not supposed to do. Oh my gosh, it's going in the opposite direction. Why did I do the thing I wasn't supposed to do? Right? But again, that's what I talked about earlier. The market will try to bait us into, right? The market's objective is to is to inflict as much pain on as many traders as possible. It says this in the market's mission statement. If you ever go to the market's mission statement, it says our job is to inflict as much pain on as many traders as possible on a daily basis, right? That's it's like a demon, right? That's his job. So it tries to bait us into doing things that we don't want to do. And for those of us that get suckered into doing it, this is how we lose money. Let me tell you this story real quick. So this was the game-changing point in my trading career. I was about to quit trading. Again, I quit 3 jobs to pursue trading full time. Stupid idea, but I was young and dumb and overconfident in myself, perhaps. But I also knew that that was the only reason I was actually going to stop being lazy and approach it the way I needed to approach it. So I gave myself about a year's worth of nest egg to like make it because I'm like, oh, I'll figure it out in a year, right? And what happened was I got to the end of the year and my results weren't good. And I was blaming everyone. I was blaming, broker, strategy, mentors, coaches, everyone. And at the end of that year, I decided to do a split test. And I looked at my trading results that I actually did all my executions. And then I looked at what my trading results would be like if I only did the things that I was supposed to do. And what do you guys get? Can you guess what happened? So on one side was the things I did do. The other side was only the things that I should have done. And what do you think I noticed? I noticed that if I simply did the things that I was supposed to do and eliminated the dumb stuff that I did, I would have been profitable. It wasn't my strategy. My strategy wasn't bad. I wasn't a bad trader as far as like the technical side. I was a bad trader psychologically, but it was me. And I made a simple fix. I said, hey, stupid, just stop making mistakes, right? So I made a goal after that. Don't laugh at me. I was making like 30 mistakes a month. Just whatever, keep that to yourself. I said starting January 1 or between January 1 and January 31st, I'm going to make less than 30 mistakes. So I wanted to eliminate my mistakes by one. I also wanted to not make the same mistake twice. And I just did that. Each month, my goal was simple, like make one less mistake. I wasn't going to be perfect. I'm still not perfect today. But make one less mistake a month. And I had given up on trading. Again, my money was gone. I didn't think it was going to work. I was filling out resumes and getting ready to go back into the workforce. And it was like, it had to be like April, I think it was. And I got a statement from my broker. And usually my broker statements, they have like the parentheses around them. I don't know if you guys know what that means. It means you lost money, right? And this one didn't. And I remember emailing my broker back and I was like, hey, you sent me the wrong statement because like Akil Stokes doesn't make money. There must be another one out there. And they sent me it again. They're like, hey, no, you had a profitable month. I'm like, what? And I had focused on the process of just trading well and eliminating mistakes and stop doing the dumb stuff. And by not stabbing myself in the foot, I was actually able to become a really good trader. So it was really cool. So, but anyway, one of my favorite reversal patterns is called the 3 bar reversal. And what happens is you get a high momentum move like this, right? And then you get ideally some type of, so this is your high momentum move down, make that a candle. Then you get some type of either rejection or indecision candle, right? So we'll just make it an indecision candle in this, come on, in this situation, right? A doji, right? So the market's giving you a pause. Then you get a higher high, higher close candle. This is one of my favorite setups. So a strong bullish candle that both breaks and closes above the previous high. So we got momentum going one way. The indecision candle is my sign of like a pause. And then the higher high, higher close is my confirmation of bullish strength. So what I was looking for in this situation was this. In this trade that I'm currently in, which I don't want to look at. I hate looking at trades. That's the easiest way to make a psychological mistake. But one, we had a break and close above structure. So we had violated our previous structure high. Higher high, higher close allows me to make a prediction that we're likely to go bullish. We then, I'm going to zoom in, came back. And do you guys notice any clues here? Notice any clues that happened in this retracement as we retraced back into that level of structure? Boom. We have our doji, our weak bearish. We have our strong bullish with a long tail. And we have our higher high, higher close right there. Price came down, put in a double bottom. We then shot up. We had some GDP news come out. Price shot up. Didn't reach my targets. Came about, what, 8 pips away. I got them at 97. So didn't quite get up there, but moved in the right direction. And now we're hugging back where we started. Yeah. So could win, could lose. I don't care. It's a good trade. As long as I don't do anything dumb right now. Now, real quick, I just want to talk about 3-bar reversals. Yeah, we'll stick there. I just want to talk about kind of stop losses because someone mentioned that earlier. And I want to talk about a little bit about using a dynamic stop loss. And this was a good example right here. So we looked at this earlier. Would you guys all agree that this is a high momentum move? Yay or nay? Yes. What's important to understand during times of volatility is that we need to be adaptable with our trades, right? When the market is moving with higher volatility, we need to give it more breathing room. When the market is moving with lower volatility, we can afford to give it less breathing room. And for my stop loss method, I use something called an ATR, right? Average true range. It's an indicator. You can see it's the yellow thing here at the bottom of my screen. If you go to like your trading view, I don't need it on the screen, but I just look at the number. What it does is it helps measure the volatility of the market within a certain range. So the higher number the ATR, the more volatile the market, the lower number, the less volatile it is. And I want to show you an example of how this can change. So let's say that I'm looking to trade right here at the end of this bearish candle, right? Price action spiked up. We had a nice rejection candle right here. Let's say I'm an aggressive, I want to trade right here, right? If I'm using an ATR stop and I'm measuring it off of, let's say, back in this area, here's what's going to happen. You see this area where there's small candles before the high momentum candle? Just give me a yes to make sure you guys see it. So the range and the volatility was shorter here, was less. So my ATR would have been about 10. So what I would have done is I would have taken the high of this candle, which is 117.31, and I would use a 1 ATR stop. So I would add 10 to it. So pretty much it would look like this. Short position right here. And what did I say my high was? My high was 117.31. That would put my stop loss at 117.42 based on that ATR. Now, who can tell me what would happen if I would have placed a stop loss there? RSI is my favorite indicator as well. Yeah. I probably would have lost, right? It looks like it missed it by a little bit, but we know how slippage works. I probably would have got stopped out. And this would have been one that I talked about earlier where it sucks because then it rolled over and you're like, what the hell? Like I called everything right and I lost. Like it's sick. It sucks. However, if I'm adaptable and adjustable with my stop loss, I want you to look at this. If I take the ATR of my previous candle, right, or this closed candle right here, the red one that we're talking about entering, don't worry about the RSI. We're not talking about the RSI right now. So we're not even using it. It's just on my chart because I use it for my personal trading, but we're not talking about it. Look at this. Let's make it disappear. Goodbye RSI. All right. If I take my ATR of this red candle and we look at the bottom right-hand corner of my screen, you see how it says 25 there? Remember, it was 10 earlier. Look in yellow. It says 25. Now, why did that number get bigger? Who can tell me? Why did the ATR get bigger? Why is it bigger here on this red candle than when I measured it earlier over here? Again, think of ATR measures volatility. So the higher the number, the more volatile the market. Yeah, we had a big move. So because we had this big, massive move that what ran up 117 pips, my average true range is telling me that the market is in a more volatile time than it was before. Does that make sense? It's telling me we have more volatility now than we did in the past. And that's reflected in that number, my ATR before this candle being in the tens versus after this candle being in 25s. Now, if I'm using my ATR correctly for the stop loss, now instead of having it just 10 pips above that 117.31, now it's going to be 25. That's going to put me at 117.56. That gives me a stop loss that's right here. What happened with this trade now? I've got a safe stop loss. Do you guys see that? I've given the market enough breathing room where it can do its dance and it can skunk all those rookie traders out that I can still win. And I'm not worried about my risk profile. I've got plenty of room, right? I've got plenty of room. And again, there's nothing to learn with ATR, but the point is, it's a tool that we can use to measure volatility in the market. And it's helpful with stop placement specifically because, again, when there's more volatility in the market is going to move within a bigger range. I hope that makes sense, right? The more volatile the market is, the bigger the range of movement is. If we understand and know that the market is going to move in a bigger range or has been moving in a bigger range, it tells us that, hey, perhaps I want to give a little bit of a bigger safety net with my stop loss versus have a really, really tight stop loss on. Because again, we can get cute all day and have a stop loss right here. And we can brag about, oh man, I got a 3-to-1 risk reward. This is awesome, blah, 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 blah. But it's pointless if you don't win the trade. It's pointless if you haven't given the market enough breathing room to skunk out all those cute traders and then do exactly what you predicted to do. It's pointless. The smart trader is going to give themselves enough breathing room. And this method of stop loss is great for that. Instead of saying, hey, I'm always going to do 1 pip or I'm always going to do 5 pips. Because 5 pips is going to be different. It's going to be different per time frame. It's going to be different per market conditions. You want to be fluid and adjustable and adaptable, yet still consistent. And if you're using the ATR, you're still consistent. So someone mentioned stop losses earlier. So I just wanted to talk about that and show how you can be adaptable. Yeah, I think we're going to end it there. I think we're right on time, if not a little bit. I can go on forever with this stuff. But we can. I'm getting a lot of questions about yeah, numbers of ATR 7 period. We can maybe answer questions later or find me on social if you want to ask me questions. What's my social? At Akil Stokes RTM or whatever like that. But yeah, hope you guys enjoyed the session. Hope I didn't get too off track. Hope you learned something out of it. And we're gonna kick it back to Jason. I'll see you guys a little bit later.
So we're not finished. Want to be as directionally correct as possible, and want to kind of set your expectations. Want to give you realistic expectations, get your mindset in the right place. Then we want to give you the fundamentals of price and what the important things you need to learn are. And now I want to take it into strategy. So I want to share strategy with you and give you some rules, give you some guidelines. And then what we're going to do is then talk about risk management, and then we're going to talk about tools and everything going forward. So the first thing I want to answer, because I'm about to go into strategy stuff, right? And you guys are going to learn this, and I know that you're probably going to get a bit excited, and you're probably going to jump the gun. A few of you, I know you will. You know, you might just go, oh, I think I can go and do this, and you'll get a little bit of a trigger finger. But you're going to be talking about, oh, how much do I need to trade and all this kind of stuff. And when you learn this strategy, I fear that you'll go and jump the gun. So I just want to cover that off real quick. How much capital should you trade with? If you're new to trading, which I'm assuming most of you are either new or you haven't quite found consistent profits yet, which is why you're here, then I would say choose an amount that you can afford to put in, right? That you're fully prepared to lose. All right. So I traded an amount that caused a bit of a emotional discomfort. So it would hurt. It made me take it serious, but it wouldn't cripple my finances if I lost it all. Okay. And also don't forget the 10% volatility rule. As human beings, we can't stomach fluctuations of plus or minus 10% without it affecting us emotionally. So you definitely don't want to be losing 10% of your net worth, say, or 10% of your total liquidity or savings. All right. So as I show you these strategies, I just want you to bear that in mind. I don't want you to jump the gun and then go and put 50% of your capital on red. That's not what this is all about. So when I think about trading strategies, what I think about is board game instructions, right? We've all played Monopoly at Christmas, where there's a never-ending game going on, and I've had games go on for 3 years in my household when I was younger. And finally, you have to kind of settle that thing. And the way that you settle it, because the reason it goes on for so long is you make up all your own rules, and then you feel sorry for Dave who's crying because he owes so much money, and the little spoilt brat kid that comes around from the extended family, he's crying and kicking off, and you have to give him an IOU. And all this stuff, right? And then eventually you have to go like, this is ridiculous. Enough is enough. Go and get the box, and then you get the rules out, and you go like, it says here, this is the rules, so you owe me money, right? And that's the only way that you really end it. And the reason that's so important here is because it's very objective. There's no arguments, and there's a set of rules that have a consistent outcome and a winner and a loser, and that's it. There's no arguing, right? So I always say, you can't be half pregnant, right? And that is what you want to be looking at, like your trade plan. You have to have yes or no. Just the same way as a 65-year-old pilot who's flown thousands of commercial jets will still go through a checklist as he goes into that cockpit, because it removes human error and it ensures that if I carry out this consistent list of things, I know that the results are consistent, and there's a high probability of a successful journey. And if I don't do these things in this order, then I don't know the outcome. Okay, there's a probability of the outcome, but it's not a probability that I know or I can be confident in. So we're going to give you a sample trade plan. We're going to send this in to you guys after. But what I want to do is talk to you about strategy. So what is a trading strategy? I'm going to take you out into the charts in a moment. I'm going to show you live examples and everything. But what a strategy is, because people overcomplicate this stuff all the time. It's patterns that happen frequently. Okay. Something that has an edge, and I'll explain how you develop an edge in a moment. It has objective rules of engagement, so board game instructions, and it can be tested, verified, and repeated. Right? That is a trading strategy. It's a pattern that happens frequently, that's got an edge, that has objective rules that you can go and test, verify, and repeat. That's all a trading strategy is. Okay. So the problem, as I said a bit earlier about signal services and just jumping system to system, is you'll look at this chart like this and you'll go, oh, I don't know what I'm looking at. My so-and-so is telling me to buy, or so-and-so is telling me to sell. And, I've got this kind of signal service or this app that says this is a strong buy or strong sell. And you don't know what you're doing, right? So the first signal comes up and it says to buy, and you get in and you put £100 in or $100 and it loses. Okay. And then the next setup comes along and you say, oh yeah, this one must be different. This must be different. I'll have another go at this. And you don't know why you're placing this trade. So you click buy and that loses as well. Right. And then what happens is you get a sell signal and you go, oh, well, perhaps I'll try the sells, because perhaps it's just the buys that are broken, and perhaps the sells are what are where it's at. So you hit sell and bang, that loses. Right. Has anyone done this, by the way? Just blindly followed? Be honest. You know, what goes on in here stays in here. I'm sure you have. We all have. We all have, right? In the hope that you're going to make some money. Right? Here's the thing, and it kind of reinforces the point I was making earlier. A weekend goes by and you go, do you know what? Next week, I'm going to just kind of see what happens. You know, I'm going to stay out of the market. So you're down $300, say, or £300. And you say, next week, I'm just gonna watch. I'm just going to observe. So all the trading setups come out and the first one says sell. And you say, do you know what? I'm just going to watch it. And bang, wins money. You'd be, let's just say that you're doing a 2-to-1 or a 1.5-to-1. You'd be up 100 and you'd be making back your profits now, right? You'd only be down, if it was a 2-to-1, you'd only be down 100 now. Okay. And you go, oh man, I should have got in. I should have got in. And you start beating yourself up about it. And then another signal comes up and you go, oh look, I just want to make sure it's working before I get in again. Right. So I just want to get in. I just want to make sure this one's okay, just to confirm the system's working again, right? And then bang, goes in, wins. You lost the money. And then what happens is you get a buy signal and you go, oh, well, let's just double check that the buy signals work. I'm just gonna watch from the sidelines, and bang, that one wins. Right? Is this familiar? And then what happens is you say to your friend, look, I'm doing this trading thing, and these are the signals that come up, and there's a sell signal right here now, but watch, I think this will roll over. And I'm not going to get involved because I think it's out to get me. And bang, that one wins. And if you'd got into all of these, you'd be up now maybe 300, 400 pounds or $400. So you think, right, now's the time. I'm going to get in. The next setup that comes along, whatever it tells me to do, I'm going to go. It must be working now. You know, it must be really working now. So you get this buy signal and you get into the market and bang, it loses. You're now down $400 or £400, even though you should be up 300 or 400. Right? Now, what you do not have the emotional capability to not break this system. And that is why you're losing over time. This is behavior that happens all the time, right? The person who developed these signals, the trader behind these signals, they see this. They see patterns that happen frequently, that have an edge, that can have board game instructions, that can be tested, repeated, and verified. And that's it. And the reason they can see this is because they've done all that work. They've done all the testing. And they know that when I trade this system, it doesn't matter if I'm going for a losing streak, because every loser brings me closer to a winner, and I just need to trade and let this edge play out over a long period of time. And I know that if I've got a reward to risk profile of a 2-to-1 and I have a 55% strike rate, I'm going to be profitable. And that's what they do. And there was a guy called H.M. Gartley, and he wrote a book called Profits in the Stock Market. This was back in 1935, I think this was published. And on page 222, he references this strategy, which was named after him, called Gartley pattern. But it's a series of board game instructions. Okay. And that's what this was, right? That's this one here. This is a Gartley setup here, right? And that's what he discovered. He discovered in the market. Now, our co-founder, Darren Oglesby, who's gone on to do much bigger and better things with his mission, but he was the guy that discovered the cipher pattern. So there are many of these patterns within the market, and your job is to identify patterns that happen frequently, build rules around them, develop an edge around them, go and test them, and go and trade them. Okay? So what I'm going to show you now is I'm going to go over to the charts and we're going to take a look at some of these. Actually, let's take a look at the Gartley setup. Okay, and I'll show you that these setups are everywhere. Okay, so Before I show you the charts, I know everyone's going to be asking about brokers. On TradingView, down the bottom, you can click on the trading panel and you'll get a list of brokers. This is who I use. I don't recommend any brokers because I just don't, but this is who I use. So if you want to play along, you can scan that and get a demo account opened up. But this is how it works, right? Let me just stop sharing this. Right. So patterns that happen frequently. Who's in my live room this week? So this was one of them, right? So this was a bullish flag breakout in the middle of this structure consolidation channel. And, the prediction is we're going to test this high. And just this morning, yesterday, we had this breakout of this channel. And today we're continuing up. This is a pattern that happens frequently that you can build rules around, that you can capitalize on if you trade it consistently. What I want to share with you is something else, right? So let's take a look at the Gartley setup, right? Now, I'm going to give you an example of a Gartley setup, and I'm going to draw it on. And the way I'm going to draw it is I'm going to use some triangles. Okay. So as we said before, I'm going to show you a bearish one, right? So the rules of a Gartley are, first of all, you have to identify what we call an impulse leg, which is the X to A move. So that's going to be an impulse drive in the market, either up or down, which you should be able to see pretty obviously. And once you've got that, we're looking for a retracement into a 618 retracement. Now, Akil mentioned Fibonacci's. What that is, so let's just say this is our X point, right? This is our A point. What we're looking for now is a valid B point. And the B point has to hit the 618 retracement from X to A. Okay. So you can see we've hit this 618. See this green line? Let's get rid of this. You see this green line? So this is the 618 retracement. What that means is it's 61% or just under 62% of that move up. Okay. That's known as the golden ratio, the golden mean. You might have heard the golden ratio at school. That's the last time I remember hearing about it until I got, ball deep into trading. But there's the B point. What we're looking for is a test of the 618. And the other rule is we can't hit the 786. Because if we hit the 786, it's then qualified for another pattern, like a butterfly pattern. So we need the 618 hit, but not the 786. And then once we've got that, that is a valid B point, right? Now, the next rule is, if I can find the triangle tool again, is we need a C leg. What does the C leg have to be? Well, the C leg has to hit the 618 as well from A to B. So we bring on the fib retracement tool again and we go from A to B. And we need the C leg to hit the 618, right? Minimum. And the only other rule is it can't penetrate A. So it can't push beyond A even by a pip. So as long as it hits that 618 and doesn't push beyond A, that is a valid C leg. And then finally, the final rule is the decompletion. And the completion point at the pattern, which means that's the point at which we know there's a high probability move to follow, which is our edge, needs to complete at a 127 extension from A to B. Okay, so you bring on your extension tool, go from A to B and back down, and you can see that 127 extension is right there at 141.25 in this case. And at that point, right, we know that there is an extremely high probability of the market to push down. Where will it push down to? Where's the highest probability point that it's going to push down to? Well, a 382 retracement would be the most highest probability zone that would test. And then the second level would be at that 618. So 2 targets or 1 target, depending on your approach. Okay. Now that's a lot to take in. Can you share the QR code again? There you go. You can go and I think you can go and grab that. You can see that maybe. Oh, and by the way, let's just talk about that real quick. This is what we're going through. So I've just explained this to you guys, but I've explained it in a bearish opportunity like this. Okay. What I want to do you have a book you can recommend So these patterns are on how I'm going to show you all of that stuff in just a moment. Okay, and we're going to do this. Then we're going to go to Akil for a bit of risk stuff, and then I'll show you all the resources that you'll need to take this further. Okay, so look, let's take a look at a live example, right? So this is the pound dollar. I'm going to remove all these drawings so it's nice and clean. Because in the real live markets, it's not as pretty, it's not as clean, it's not as nice looking, and you need to practice seeing these patterns so that they pop. You need to build something called your reticular activating system, which is the part of your brain that sees patterns and familiarity and stops you going mad, basically, stops you focusing on everything around you. And what we're going to do is we're going to say, right, let's see if we can see a Gartley setup. Well, look, here's an impulse leg, right? So this is a big drive down where we've had this X to A. So we can label this up as well. So we can say X, here's our X leg, right? And then we could say, well, here's our A leg, right? Now, what do we need? You guys remember? We bring on our fib retracement tool and we go from X to A. And we need the 618 to be tested, but we can't touch the 786. Okay, so I'm going to draw this on nice and clean so you guys can follow along. So you can see X, A, B. We've now got our B leg here, which touched the 618 but didn't touch the 786. Okay, now that's a really nice pattern, and I'll tell you why. Because it's pushed quite deep into that 618 to 786 zone, which means that the completion point will be even higher, which means the reward to risk profile will be better. I'll explain what I mean now, right? So let's double check that we've got a valid C leg first, because we don't want to trade this if we don't, because then we don't know what we're trading. We don't know the expectancy of the outcome. So what we want to do now is we want to go from A to B, and we want to make sure that we've hit that 618, which is yes, tick. And what aren't we allowed to do? We're not allowed to violate A. Okay? And we haven't pushed below A. We've just got our 618 here. Haven't pushed below down here, A, right? And then finally, the last rule, if you guys remember, is a fib extension from A to B and back down. Okay? And we're looking for that 127 extension for the completion, which in this case is at 135.85. And there we have a live singing and dancing Gartley pattern in the wild, in the real live markets, that is still as effective today as it was back in 1935 and before that. That's because human behavior and market participants' behavior has not changed. These patterns, these ratio patterns, these Fibonacci patterns, why they work, we don't care. Why they're everywhere in nature, we'll never understand. We're too stupid, right? But they are. And if they're there, and we're confident they're there, and we can prove they're there, and test them, and repeat and verify them, and repeat them, gives us supreme confidence that we can make money. Okay. Now, so what does this mean? This is a setup here. What does it mean? This means that if price pushes up to here, and notice I say if price pushes up here, there is a high probability that the market will roll over to the 382 retracement. Okay. So at this point, what we can do is we can set an alert at the B leg to let us know when price is pushing beyond that point. I'm going to delete that one because I don't know if that was up or down, but we can add an alert here, right? So I can add an alert at the B leg, and I can say potential bearish Gartley formation on the 240 chart. Okay. And I could say bear Gartley, B penetration. So that means that the B leg's been penetrated and we should start looking for getting our orders on. You could set a sell limit order here. You could literally just go and sell this thing and get your limit order in. But But we now know that we've got this high probability setup here, and there's a setup. There's an opportunity. Okay, so in terms of reward to risk profile, what this would look like is if we're getting in here at 35.85 and our stop loss is going to go above X. Now, where does your stop loss go? You can either use a fib inversion again. So we can go 113 inversion above X. And our target is it's all based on fib ratios. So our target is going to be at that 382, which is where this arrow is, right? Get rid of this, get rid of this. And we're looking at a 2-to-1 setup. And because we've tested and verified and repeated these and demo traded them and paper traded them, and now we've traded them live for so many years, we know that we've got confidence to take every single one of these that plays out. And if we're right 55% of the time, but we've got a 2-to-1 on every setup, we don't care. We just trade it. We trade it and trade it and trade it and trade it and trade it. And our job as a trader is just to show up, and our plan tells us that we must take this. We don't have a choice. We have to take this. Okay. Now, what happens if the market pushes down? Well, recently we've been seeing a lot of consolidation, and what you'll notice about these patterns is these patterns form in consolidation, very prolific in consolidation. So what you might see is down here, and by the way, there's a tool here where you can draw these on straight away. You might see another setup down here, right? So this one is what we call a butterfly pattern. And a butterfly pattern has a different set of rules of engagement. But guess what? If you know those as well, if the market pushes up, you've got a high probability setup. If market pushes down, you've got a high probability setup. And you've got a toolbox that, depending on what the situation is, you've got a tool to capitalize and maximize profit out of any situation. Market goes up, I know I'm going to make, there's a high probability I'll make money over time trading this setup. Market pushes down, I know I've got a high probability of making money if market pushes down to that area. Does that make sense to everyone? So what I would say is as your homework, you're going to want to rewatch this, of course. I've just given you, a week's worth of training and identification and strategy in about 15, 20 minutes. But you're going to want to go and rewatch the recording. You're going to want to take notes, and you're going to want to go and practice seeing these things and committing it to memory, and then going back over historical data, and you'll see that these things are absolutely everywhere. Every time the market goes into consolidation, which, by the way, we're in like 70, 80% of the time in the Forex market, you can come in and you can say, right, what am I looking for? I'm looking for that impulse leg. Then I'm looking for the X to A to B, B to C, CD completion. Okay. Once you've done that, once you've gone through all that and you've practiced that, you can then go on to another market and another market and another market. And what I would say is, when you're testing these rules, you want to make sure that you stick to one strategy, one time frame, and then do pair at a time. So you exhaust every single pair that you plan on testing it on before you move on to another pattern. And the reason being is because if you're doing too many at once, or you're doing too many different strategies at once, or too many patterns at once, what will happen is you will dilute your RAS. You'll lose the ability to be able to spot the patterns, right? So you want to make sure that you don't lose that ability. You want to make sure that you are, still capable. They're just popping out to you. But you can go through and you can go and start practicing looking at these things, right? So look at this one. I don't know if this one completed actually. Let me just double check. Yeah, that one didn't actually complete, but they're everywhere. And I think what would be great for you guys to do is to go in and go into a time frame and start figuring out and identifying these zones for yourself. Use the rules of engagement that I've just explained to you, and have a little practice. Would you use lower time frame for this? I wouldn't use lower time frame if you're new. No, purely for the reason that it's going to be too noisy. It's like if you tried to learn a guitar and you just started trying to play Metallica on day one, or a Slash solo, you're probably not going to have much luck, right? It's too noisy, it's too much going on, too much muscle memory, too much focus. There's too much that isn't subconscious. You're having to focus and be conscious about every move. Whereas if it's all second nature and there's less noise, then you can focus more, you can breathe more, there's not as much panic. So practice on the higher time frames, and then if you feel like you can spot them really easily, really quickly, and you can get your profit targets in nice and quickly, then you could drop down the time frames. But I wouldn't start there. And then what happens is when you get moments like this structure consolidation zone on the dollar here, you get tons of these things, right? So I can see that there was a Gartley here, right? There's a Gartley right there. Bang! Look at that. Soon as it completed, boom, straight into targets, stratosphere. Okay. There could be another one. There could be another one in here, depending on whether or not this would be a valid X to A leg for you. There could be another one right here, right? So they're everywhere. And as soon as we hit these consolidation periods like this, like you're seeing on the euro here, that's where they're prolific. They're hiding in the shadows. They literally breed like rabbits in these zones. So really, really exciting strategy to have in your toolbox. And I want you to have a think about that. What I do want to do is I just want to go over to the what do I want to do? Yeah, I want to go over to Akil now. And then Akil's just going to do a little session now. And then I'm going to come back and I'm going to show you all the resources, all the tools that you need to move forward. Okay. So guys, if you've got any questions, fire them in. I know that was a short and punchy session, but we're going to keep it punchy. We want you to go and watch the recordings. We want you to go and practice. I'm going to hand back over to Akil. Just quickly, he's going to do a short session and hand back to me, and I'm going to finish strong. So I will see you in a minute.
There we go. Volume should be back now. I don't know if I had my light on earlier. I forgot to put it on so you guys can see my pretty face. But yeah, back to business. Let me share my screen real quick so you guys can see it real quick for you guys that have been tracking, like we're watching. We talk about trading. Can you guys see my screen first and foremost? I got to put the chat back up. Here we go. Yep. We talk about the mental battle of trading, and we're going to talk a little bit about that in this session too with risk. But I want you to take a look at what has actually happened here. Again, with this trade, I entered this morning. It was like, what, right around 7 o'clock, a little bit before there. And look what this trade did, right? Immediately entered, took me into the negative, then took me into the positive, then took me back into the negative, then took me into the positive, then took me into the negative, now back into positive. Remember earlier how I spoke about making lots of mistakes and self-inflicted wounds? Do you guys see how that happens? Like, I don't know how many of you guys have ever traded, but like this, before the market had numbed me, right? This is an emotional roller coaster. This is an emotional roller coaster. I have the P&L on my chart so you guys can see it. I never leave the P&L on my chart because looking at a monetary figure just makes you even more insane and crazy. And I'll tell you what, one of the biggest mistakes that traders make is, right? So we went through what? We went down, then up, then down again, then up again, then down again, right? The market is up right now. We're approaching the previous highs. Up about what? $350 on this. What do you think you would likely do at this situation? Is anyone tempted? Is anyone screaming at the chart, Akil, you're an idiot, just like cash out? Be honest, anybody thinking that? Yeah. Yes. But guess what? That is breaking the rules. We look at the risk profile of this trade. It was managed a little bit, but it started off almost 2-to-1, right? Meaning managed, there was active trade management. I rolled the stops up a little bit from the initial placement, but it was pretty much a 2-to-1, almost 2-to-1 risk reward, right? Which means that, and Jason showed you the graph earlier, if I were to take this same exact move with this same exact risk profile, if I took this, 10 times, I can win, 4 times and still be profitable. But what if I consistently take profits off here? Well, all of a sudden, that's a negative risk reward, right? Now, all of a sudden, where my system requires a 50% or less than 50% hit rate for me to be a profitable trader, all of a sudden, I'm in a position where, yeah, I'm hitting at 50%, but I notice I'm losing money. This is exactly what I was doing when I was self-sabotaging. It was dumb mistakes like this. And I was looking at my results and I'm looking at it. I'm like, hey, like I'm doing the things I'm supposed to be doing. How come I'm not making the profit that I'm supposed to be making? And it was because I was doing little things. I was taking targets early, moving stops a little bit back, right? Stopping myself out early, all types of the whole list of things I was doing. But this is a perfect example because, our job here as traders, Jason and myself, is like, we're no fluff, no BS, right? There are people out there that are going to tell you trading is easy and make it look easy. And no, it's very difficult. But the part that's simple, as Jason mentioned earlier, isn't the actual trading, right? Getting into this trade was simple. Price action broke a level of structure. It came back into structure. It gave me a nice candlestick setup. I pushed a button, right? Big whoop, right? I do it all the time. The difficult part is sitting in this as it yo-yos me back and forth across like the wrestling ring, baiting me to break my rules. I'm not going to do it. And that's what separates myself and the other good traders out there from the ones that are struggling, the boomer busters, is that we're emotionally disciplined enough to be like, look, I don't care whether this wins or loses, right? This isn't going to make or break my life, right? If I lose 500 bucks, it's big deal. And again, we look at it more in percentages, not the actual monetary figure. But the point is, my job is I want to take a good trade. And a good trade for me is letting this play out to my prediction. Whether it's a winning prediction or whether it's a losing prediction, let it play out. Because you know what's not going to bother me? The loss. This loss is about 1% of this account, less than 1% of this account, right? Is a 1% loss going to kill me as a trader? No. So something that you can do to handle those emotions is trade with the right size. If you trade with the right size, it eliminates many of those emotions. Most of our trading emotions are there is a pride and an ego thing. My target profit's right up here at the top, this green dude, right? Some of it's pride and ego. Like traders want to be right. There's nothing wrong with that. But most of our mistakes are made off of emotions, and our emotions are tied very closely to money. We like making money, we don't like losing money. And mistakes are made when traders get afraid of either leaving money on the table, which isn't theirs, by the way, or losing money. But I can tell you, if you trade with the right size and you understand the size and the law of large numbers, losing money shouldn't really hurt you. Let me ask you guys this a question before we dig into the presentation. If you were walking down the street and you dropped a diamond ring, would you be upset? Right? I don't know how much diamond rings cost. You could tell by how I dress. I don't buy anything expensive, but you'd probably be upset. You'd probably, yeah, you'd probably walk back, you'd search, you'd call, you panic. If you were walking down the street and you dropped a penny, would you care? Think about your position sizing being the same way. You should trade with a size that isn't going to make you super happy and change your life if you win. It's not a lottery. But it's also not going to make you panicky and afraid if you lose. And the more you can put yourself in that situation where you're avoiding being panicky and afraid, the more likely you are to follow your rules. The more likely you are to follow your rules, the more likely you are to let your edge play out. The more likely you are to let your edge play out, the more likely you are to be profitable in the long run. So it all starts there. So let's dig into how do I get this on position sizing a little bit. And I'm going to start with a great quote that I always butcher, but I wrote it down this time so I don't have to butcher it. I was told this by a few great traders, but good traders are great risk managers. That's all it really is, right? It's not about good traders aren't super secret strategy people. They're good at what they do, but there's not really doing anything fancy. The thing that they're doing the best is they have the ability to manage risk. they don't do dumb stuff, right? They don't do dumb stuff. They don't put themselves in the position to do dumb stuff. And if you notice the theme of this workshop, it's like most traders fail mainly because they do dumb stuff. With that being said, the number one rule of trading is conservation of capital or don't go broke. Chip in a chair. As long as you have money in your account, you can trade. As long as you have the ability to trade, you can profit off your trading. If you go broke, blow everything, boom, you have no ability to trade, you can't make money, you're sunk in a hole. And I'll show you guys some examples of this later. Now, real quick, these are equity curves. Are we all familiar with what equity curves are? Line charts of your return on investment, how much you make. No, no, okay, no. Okay. Yeah, so an equity curve is pretty much it's a line chart of your performance. So just like a trend, if you are profitable, hopefully it's going from the bottom left to the top right. If you're not profitable, it's going from the top left to the bottom right. So you want it to be going upwards, up and to the right. That means you are making money, right? How much money doesn't really matter, but you're making money. But I want you to pick out something that these are all different equity curves. I just randomly found these on the internet. But what do you notice in all of them? Are any of these equity curves a straight line? They all have ups and well done. Yeah, they all have ups and downs, right? Ups are going to be your extensions. Those are periods where you're making money. Downs are going to be your retracements. Those are going to be called your drawdowns, the periods where you're losing money, right? It's important to understand all traders go through drawdowns. In fact, this is going to be a little bit depressing. The majority of your trading lifetime is going to be spent in a drawdown. Now, the biggest difference between the profitable traders and the losing traders is that, once again, good traders are great risk managers. Good traders are able to manage their drawdown, and they manage that drawdown in two ways. One, they're trading with correct size, correct risk. That way, when they hit that losing streak, it doesn't really hurt them too much. They can survive. They can tread in the water until that next win streak comes. On the other hand, traders that are not trading with the correct size, that losing streak is going to take them out. And I'll show you some numbers on that later. But they're surviving those losing streaks, and then they're taking advantage of their winning streaks. And that's how you have longevity in trading. It's not always pretty. It's not a direct, look at the bottom right one, for example. It's not a direct path up. But I tell you what, end of the day, here to here, that's a win. But all traders go through this. So losses are normal, and you need to accept that. So let's talk about risk in a few different ways here. And we're going to talk about kind of different things to pay attention to. I want to bring this up because this is relevant to kind of our talk about volatility. And there is three ways to measure risk. I have the slides backwards, but there's three ways to manage risk, and particularly in volatile markets, right? One is be aware of high impact news events. Two is proper position sizing, which we talked about already. And three, as I mentioned earlier as well, avoiding psychological traps. So I get a lot of questions about news. I would tell you this, in general, you don't need to be an expert on news. I was not a fundamental trader at all when I first got started. I knew nothing about fundamentals. I got a D plus in my economics class in college, and that was about it. So you don't need to be an expert at these things to be a trader. Over the years, just speaking with other traders in the field, I've acquired a knowledge of them, and just by being in the market for close to 20 years now. And I can tell you this. One, you don't necessarily want to trade off news, especially as a newer trader, but understanding news can be beneficial. For what reasons? Who can tell me why? What could be a benefit of understanding news, and specifically when a news event may come out? We're not trying to trade it. We're not trying to. I did the thing in the past where I would sit here every first Friday and I'd trade the non-farms, and I got lucky once and thought trading would be that simple. Then I lost like 20 times in a row after that, right? Yeah, I got lucky, Jason. Sat here, traded non-farms, like made like 200 pips. I'm like, man, I'm going to trade once a month for the rest of my life. That's what I'm talking about. Time freedom, baby. Travel the world and just like load up my computer. Friday, 8:15. All right, let's do this. Right? It wasn't so simple. Yeah. Um, but if good traders are great risk managers, news events could tell you when to keep your powder dry. They can tell you, hey, when to be out of the market. I know the big volatile moves, they're sexy, right? Going back to the chart I showed you, right? Everyone wants to be involved in, where's it at? Everyone wants to be involved in this move. Like in hindsight, man, you're looking at this, you're like, man, it would have been so great to catch this, right? Give me a yes if you guys would have loved to catch this move. Of course, right? Now let me ask you this. How would you have felt if you were on the other side? What if you were short here? Would you still be answering the same way? Oh, Akil, I love it. Yeah, you would have been gutted. Yeah. And the fact is, in hindsight, we can look at this and be like, yeah, that's a great move up. In real time, did we know it was going to do that? Hell no. And I don't care who you spoke to, they did not know. There are clues and you can speculate, but no. So the best thing to do in this situation, and you can ask the traders that I work with, sit on the sidelines, stay away. I will wait until after the move occurs and then I'll reevaluate. I got a question came through. What happens if you're already in a trade? Well, you have two choices. You can stay in the trade or exit before the news event comes out. These are personal decisions that you guys will have to make, whether you want to trade news or not. And being aware of news will let you know which ones to avoid and which ones you may not need to avoid. Because again, there's going to be news every day. You can check an economic calendar. 90% of the news events are going to be irrelevant. So we see traders on both sides. We see traders, and I took this when I first started trading. One, they took the stance of like, I'm not going to avoid any news event. That was me. I was technical trader. Fundamentals were stupid. I'm trading through everything. And that's how my mentor taught me. And then I would see some of these news events and I'd be like, Akil, that was stupid. Why the hell was I trading through that? But then you get the other hand where people want to avoid every news event. And guess what? You never trade because there's a news event, man, especially during the London and New York session. Shoot, sometimes it's all day. So it is beneficial to know and be aware of what news events can particularly move the market, like I just showed you, and then which news events are gonna be like blah. Like there was a news event this morning on the euro dollar trade that I took that was important, but something that I didn't think would move the market significantly. So anyway, tier one news, right? These are going to be news events that it says always market moving, not always. Understand that conditions change, right? The market cares about certain things in different times. Like again, for this last decade or so, I've never seen this much change in monetary policy. So that's been a main thing. However, we've had periods where monetary policy was fine and no one changed anything. So therefore, interest rate decisions didn't move the market at all. So it's all fluid, but just in general terms. So stuff like interest rate decisions. If you had to think of the main cog, like the main thing the market cares about, the main show, right? Interest rate decisions are the number one thing that the financial markets care about. I hope you guys understand that. If you had to choose one thing, everything, if you look at them as gears, interest rate decisions, monetary policy is the main thing. After that, it's all the things that affect the main thing. That's what the market cares about. So you see interest rate decisions here, monetary policy, non-farm payrolls is one, CPI, that's inflation based, so that affects monetary policy, GDP, Fed chairs, and important people speaking. Those are going to be typically high impact news events, stuff that you may want to avoid. Tier two news events, these are going to be important, but sometimes they move the market if the market cares about them, sometimes they don't. Right? You'll see PCE, another inflation gauge, unemployment, jobs, retail sales, some oil stuff every once in a while, elections, right? Those could move the markets depending on the situation. And then there's the wild cards, right? So all the news events that I mentioned before are typically scheduled. You can look on an economic calendar. You can see right away, oh, Thursday, 8 o'clock, this is coming out. You can plan for it. This is the stuff that moves the markets that you can't plan for. Conflicts, wars, right? We got a lot of that going on right now, unfortunately. Natural disasters, right? The tsunami the other day, although that didn't move the market too much. I remember getting caught up in a tsunami trade where the yen pairs like tanked by a million pips because whatever that big tsunami was back in, I want to say 2012, something like that, was damaging. And we saw a ripple across the financial markets. Central bank emergency meetings, credit rating downgrades. We've seen that in the USA. And here's one: Trump tweets. This is probably the biggest one of this past decade. It's been the Trump tweets. Historically, presidents or people in powerful positions don't really make public statements. Trump was one of the first presidents that came out and made public statements. And some of those public statements are factual, some are not factual, but the market doesn't really know how to interpret it. So it goes into this panic phase and it moves. Do you consider Trump decisions good or bad for the market? I consider Trump tweets bad because it puts in volatility where and disruption. Um, those would be negative because what happens is you see a short-term reaction and then the market kind of fact checks and either agrees or disagrees and it goes back to normal. But in the short term, it can kind of cause some funky movement. So those are things to avoid, right? Or to be aware of. Next is going to be position sizing. And this is what we spoke about a little bit earlier, right? So there's a few different ways we can look at money management or risk management. One, there's position sizing, right? This is the position of your individual trade. How many pips are you trading? How many lots are you trading? Standard lots, mini lots, right? How much are you risking per trade? How much are you risking for your total portfolio? That's something to pay attention to as well. Sometimes traders, especially ones that want a lot of frequency, they're trading a big portfolio. So let's say you're trading 20 pairs at a time. If you were in 20 trades at the same time and you were risking 2% per trade, all of a sudden, that's a massive open risk. Margin call may be right around the corner if a few things don't go your way. This happened to me. I made a $30,000 mistake like this, where I was too exposed and pretty much lost $30,000 in, I call it a few weeks. It was honestly a few days because I looked at my individual risk and I kept that in track, but I never paid attention to my entire trading portfolio risk. Another thing to be aware of is what's called maximum allowable drawdown. This is kind of like your cutoff. We should all have a cutoff, right? If you go below a certain level, meaning that you're in a funk, if you go below a certain level, you need to stop yourself from trading. Think about it like an athlete. If a pitcher is having a bad day, what happens? The coach yanks him. If a player is having a bad day, right, the coach subs him out. There needs to be a point where if your performance isn't going up to par and it's going so poor, and this number should be below kind of the average expectation of a drawdown, you need to shut yourself down before you damage your account. Now, here's a question for you before we move on to the next slide. Going back to position sizing. How much do you think most professional traders risk per trade? What percentage? Type it in for me. I see ones and twos and 1.5s or 0.5s, three. Yeah. So what you'll hear, rule of thumb, is that most professional traders risk between 1% and 2%. Is that surprising to anyone? Now, again, to each his own. It's your money. You can do whatever the hell you want with it. But good. That's very risk averse. It's very hard, and we'll show some charts in a little bit, to go broke risking 1% to 2%. The problem is when you hear about these gurus on the internet making these massive returns, they're doing so risking so much more. But when things don't go their way, it kills them. So I want you to take a look. We're going to talk about losing, right? And I want you to take a look at what a losing streak would look like if you're risking 1% per trade. You lose one trade, you're down 1%. You lose 5 trades in a row, you're down a little bit under 5%. You lose 15 trades in a row. Anyone lose 15 trades in a row? Type in your longest losing streak. Mine was 17. Anyone dare to beat that? Not proud of it. 17. Anyone? What's your longest losing streak? Someone's going to type in forever. No one wants to share? No? Years. Oh gosh. 13. All right. So just to give you my example of 17, we'll cut it at 15 and give myself some slack, right? If I were to lose 15 trades in a row, that's a lot. You got to be really bad to do that. If I were to lose 15 trades in a row, I would only be down 14% of my trading account. It's kind of crazy, right? This next sheet I want to show you is called the maximum drawdown recovery. So what these numbers represent is this. The number on your left, the white numbers, that's how much your drawdown is. The green numbers is how much you would have to make back to get the break even. So if you're at a 5% drawdown, you have to make 5.3% back just to get back to break even to where you were at before. If you're at 10%, you got to make 11.1. If you're at 25%, you got to make 33.3. So in that graph I just showed you where I lost, what, 15 in a row, right? That was, what, a 13% drawdown, 14% drawdown. So in order to dig myself out of a 14% drawdown, I've got to make about 17% back. Now remember that number because I want to show you something else. For those who are trading with too much size, this is what that losing streak looks like for them. Remember I told you I took 15 in a row and I lost about 14%? All of a sudden, if I take 15 losses in a row, risking 5% per trade, that puts me at negative 53%. Let that number marinate, guys. Where before it was 13 or 14%, which is doable, this is at 53%. That's half your account. Now, going back to that maximum allowable drawdown recovery chart, excuse me, if you lost 50% of your account, you have to make 100% to get back to break even. Guess what most traders don't do in a year? They don't make 100% in a year. So you would have to do something out of the norm just to get back to break even. Now, guess what this encourages you to do? Overtrade. I got to make it back. I got to trade more. I got to find more opportunities. Got to dig myself out of this hole even faster. And it's kind of like quicksand, or at least what I've heard about quicksand from TV shows. The more you fight in quicksand, the faster you sink in. I don't know if that's true. Is that actually true? I've never been in quicksand. I'm from the city. I stay away from stuff like that. I'm from Philadelphia. We don't have sand. We're landlocked. But I heard it's true. But this is what gets traders in the trouble. They dig themselves into a hole. They have to do more to get themselves out of a hole. But when they do more, they're just doing more of the bad things that put them into a bigger hole. And just for one last visual real quick, here's a look at the difference between, again, the drawdown on a 1% risk in blue versus a 5% risk. Good traders are great risk managers. Give yourself a chance to survive, especially as a newer trader. As a newer trader, at the beginning of your trading career, you're going to be the worst you ever are. You have the most likely chance of losing money. So you should be trading as small as possible during that time. When you get better, you want to risk more, feel free, right? You should be a better trader by then. But especially as a newer trader, just survive. Just survive. And again, we talked about many of these already, but just the self-sabotage, right? There's really two main things that we do to self-sabotage ourselves. One is going to be FOMO, fear of missing out, where we have to make money. Everyone else is making money. I can't let this trade get away. I'm going to get involved. We want to follow our rules. We want to wait. We want to be patient, but we can't because we have to trade. And then we end up getting into positions that we're not supposed to be in. Or like the example I showed you earlier, where, hey, I'm in this trade and it's shooting up towards profit. Now it just went back down. Oh, sorry, get back to reality here. I'm in this trade. I'm shooting back towards profit. Oh my gosh, it's here in a 5-minute chart. It's going back down again. I'm going to miss out on profit. I got to exit my position. fear of missing out is going to kill us. Then on the opposite side of the spectrum, we see this a lot too, fear of getting involved. I actually worked with a trader a couple months ago who was dealing with the same thing. I told the story to the live room members where a trader we were working with on the platform, he was emailing me daily, just say, sharing with me his trading ideas. We traded very similarly, so I was seeing a lot of the same things. So I'd wake up to a daily email, hey, Akil, I'm looking at Euro Yen, blah, 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 blah. I'm like, hey, I'm looking at the same thing, blah, blah, waiting for this and this and this. Hope to get involved. Day would go on, trade would trigger, I'd get involved. I get an email the next day, be like, hey, how'd that trade going? I hit profits with the euro. Were you able to get out? And he's like, well, I never entered the trade. I'm like, well, why? Like, you did all the hard work. You did the analysis, you made the prediction. He's like, yeah, I did everything, but I couldn't bring myself to pull the trigger because all the fears started. What if I lose? What if I made a mistake? All these different emotional and mental fears that happen to us. So we see it on that end as well, where sometimes traders get involved too quickly. They don't have enough patience. But then sometimes traders are so fearful that they never actually get involved. There's many excuses. Like some people will backtest forever. Some people, I'm going to go try a different strategy where at some point we have to get involved. And if you can kind of avoid these two forms of self-sabotage, it's going to help massively with, again, you doing the right thing, you following the correct process, and understanding that if you follow the correct process, you're going to get the correct outcome that is expected from that process. So, a really quick session on risk management, position sizing. It's super important. We talked a little bit earlier about the ATRs and being adaptable and adjustable and staying within your range, not trading too big. But this is stuff that's going to make or break you as a trader. Real quick, just any questions about that? And I wanted to be quick on purpose since kind of went over on the first one. But any questions on that? It's not the sexiest stuff in the world, but this is the stuff that makes a difference. Trust me. All right. If not, I'll head it back over to Jason. Yeah, no one likes hearing about this stuff.
All right, man. Just quickly on the Gartley, you can see that we've got a position set here now. I've placed this order here as a limit order. And a limit order is basically something that you can set and forget. So basically, I'm saying that if market pushes up to this price here at 135.85, then I want to sell a certain position of that market, and I want to take my profits off down here. I want to, buy back essentially at 35.11, and if I'm wrong, I want to accept that I'm wrong at 36.23 at a loss. And you can see that's about a 2-to-1 reward to risk profile there. And the way that I have a dynamic way of managing risk, I have a money management strategy that's a bit more advanced that we teach inside tier 1, but it depends on what setup it is, what strategy it is, what market it is, what time frame. I have various different risk tolerances for different things. But we're not going to go into that right now. I just wanted to show you that that is how you would set an order, and if this one triggers, then we could make $6,000, £4,000, something like that, which is pretty nice. What I want to talk about quickly before I show you the tools and the resources that can really help you from here on out is I want to talk to you about where you go from here. Setting a goal, setting the roadmap on what you need to do. So the first thing to do is, if you've got this trading goal, what you want to do is break that out into steps. You want to say, right, well, the first thing I need to learn is I need to understand the basics. Okay, we've covered a lot of that on today's session, but we haven't covered, we've covered as much as we can, but you might not have understood it. Okay, so you want to understand the basics. Then you want to understand, maybe you want to understand a trading charting package, right? So you might want to get familiar with a platform. And then after that, you might want to learn a strategy. Okay. And then you might want to test a strategy. So you might want to learn a series of strategies and then pick one that resonates with you. And then after that, you want to go and back test. Okay. Strategies. Then you want to go and build a trade plan and put that all together, right? And then you want to go live. So now what you can do is in each of these, let's just say that you're going to start this on what, the 1st of September, maybe, let's say 2025. And let's just say we're going to finish this thing on 1st of December 2025. And this is our little goal for the next 3 months or 4 months, into 4 months. Now, what we can do is we can break that down so it's not overwhelming. In other words, we can just take a look at each of these and say, right, understanding the basics, right? So I need to learn candlesticks, right? Thoroughly. I need to learn support and resistance. I need to learn indicators. I need to learn position sizing, right? So pips and things like that. You need to learn a little bit about brokers. You need to learn a little bit about, you know, the charting, right? So you do that. Okay. Now, you can then realistically put time frames next to this, and you say, well, to learn candlesticks, I'm going to set myself, 8 hours, say, and you put 8 hours. And then for support and resistance, you might give yourself 20 hours. So you might say it's going to take me 20 hours. Or like a couple of days, you might even say, you know what, 3 days. I'm gonna spend 3 days learning that. And then indicators, I'm gonna learn in a couple of days as well. So add that in there, right? So you can basically break down your roadmap so that you've got a realistic timeline, and you remove all the overwhelm, and you've got actual, guided sessions that you can now just focus on that one thing and don't move on until you do that one thing. Okay. So this might take you, 1 hour. This might take you 5 hours, right? And this might take you 2 hours. And now you can see where your time needs to be spent the most. And then you might do a charting package. So you might go, you know what, I need to download one, then I need to link demo, then I need to navigate charting, the charts. Then you might need to play around with the tools and learn the tools, then the automations and things like that, right? And you might have all these things and so on until the point where you've got this really nice plan. And then you just go into your calendar and you go up here and you say, this is my 2025 weekly planner. And on Monday morning, I'm going to do a trading session. And I'm going to start it at 08 a.m. Okay. And I'm going to finish it at 09 a.m. Every Monday, I'm going to do that. And then on a Saturday, I'm going to do a big session. And that's going to be, I don't know, 08 a.m. until, say, 12 p.m. Right? So you've got now 5 hours. And during those times in your calendar, you just come in here and you start ticking these things off, right? So you go, yeah, done that one now, right? And then Saturday comes and you go, what? I've got 3 hours to do that. Done, right? Done. And as the time elapsed, your progress just needs to beat the time. But even if it doesn't, even if you don't get it done by the 1st of December, at least you're making directionally correct progress, which is what we're all about at Tier 1. This is exactly what we're about at Tier 1. In fact, to the degree where we created a 90-day planner. So as soon as you get inside Tier 1, you get access to this 90-day planner, which guides you on everything. Do this first, do this second, this should take this long, do that last, and so on and so on. So you not only have you got a structured roadmap on how to get there, but you're also got the endorphins and the motivation release when you're ticking these things off. Who loves a checklist here? I'm such a sucker for a tick list. Oh, I mean, it's just the best. It's the only way, right? Everyone gets access. Everyone in Tier 1 gets access to this. This is the tool that we give you guys, right? And this can be used for everything, not just your trading goals, but you take the time to fill this thing out. You've got almost certainty that you're going to succeed. Okay. There's a much higher probability of you succeeding as a trader if you've got this than there is if you haven't. And that is what all of the emphasis at Tier 1 has been put on. How can the only way traders fail is if they give up? How can we make it so that the only way they will fail is if they just give up, and any other way they will succeed? And that's how we built tier one trading. You know, I'm just excited to announce that I don't know if I should say too much about this at the moment, but we've gone to the degree where we're building a trading journal where you can track your trades, track your emotions. It's a full journal. It analyzes your strategies. You've also got an AI version of myself and Akil at all times where we can coach you and you can talk to us, which is going to be phenomenal. I'm really excited about that. I'm saying way too much though, so I'm gonna stop that there, and I'm gonna go back over to the old slides. Now you've probably still got loads of questions like automated systems, signal services. Hopefully we've kind of abolished or ridiculed and helped you see logic in some of those things, but there's obviously other questions that you might have, like scalping and Bollinger Bands, stochastic trading, you know, all these apps and other things that you might have on your mind. And usually what ends up happening is you go around and you try and figure all that stuff out, and you end up with more injury than you need. So we know at tier one, it's not about giving you loads of stuff. Okay, you don't want stuff, you want outcomes. And the most important thing, the only reason any of you are here is because, one, you want to place a professional live trade, right? Where you're confident in that you know what you're doing. That's one most important thing to you guys. Two, withstanding a drawdown. So that's a very important milestone. That's where you go through a losing streak, but because you're so consistently profitable that you come out the other end of it and you are making profits and you can actually pay for things in your lifestyle with confidence because you're making money. And then lastly, income replacement of some form, whether that's an extra 200 a week or 500 a week or 1,000 a week or whatever it might be. Income replacement. That's why you're all here, to have some level of income replacement. Is that fair to say? You're here for options on your income. That's it. That's the only reason we're here. It's the only reason we all do it. By being laser focused on getting those results for people, serving that outcome for people, we've been able to develop a platform so powerful that was recognized by Forbes magazine within 3 months of us launching. And that is tier one trading. So I'm going to talk to you a little bit about how this works. And I'm going to share with you exactly what you get with tier one and why, and I'll help you see why this is the only way that's going to get you to A to B as most efficiently as possible. Okay. And hopefully you can see that. All right. So that is the training. And I know that you guys are probably chomping at the bit now to do the next thing. And I want to recommend a couple of things for you. First of all, I run a trader challenge. So a 30-day trader challenge, which you might have seen on my other video. And if you haven't seen my Trading for Dummies video series, go and watch that now. Phenomenal series it's the most popular trader training video in the world. It's got the most views and it's got the highest rankings. So it's an amazing piece of work, great training. You can go and watch that. But also the 30-day trader challenge, I'm going to put the link in the description here. Okay, and you can go and check that out. And that's there for if you just want to get your feet wet, build a lot of confidence on going from zero to being confident placing your first trade in the next 30 days. You can go and check that out. It's a 30-day challenge. But if you really want to hear what tier one trading has to offer, you know, and you was like looking forward to seeing how you can get more involved with tier one, you can go to the link in the description here, tier one trading link, and it will show you what's involved when you come and work with tier one trading. And if you want to go and check that out, you can. But I hope you've got all the value that you wanted to get from this video. There's lots more on this channel, so you can go and watch plenty more where that came from. But until next time, take care, good luck in the markets, and stay in touch.